Yes.
Okay, we'll
Shall we
start.
start?
Yeah, we'll start.
We can start.
Yes, we are live on YouTube.
Yeah. Shilpa madam, maruda.
Yes, please.
Start.
Yes.
Start. Respected chairman, secretary, respected resource person of the day, and all those gathered over here for this session. A very good morning and a cordial welcome to all of you. Today we have assembled here on this platform to dwell upon two very interesting topics, and topics which are pole apart, which we have brought them together. The first, it is broken into two sessions. The first session will be upon FEMA regulations for foreign direct investments, a term FDI that we have often heard and made a lot of news, something which the resource person for the day will dwell more upon that. And the second half will be on the cryptocurrency, as we call it, the crypto talks, the introduction and the future of cryptocurrency, a foreign term for most of us, which will have more enlightenment as the session goes forward. And today we have with us as resource person, CPE Sridhar sir. I welcome you, sir. And once again, welcome all the participants and formally request our chairman of the branch, KS Kamath sir, to welcome the gathering.
Thank you, Gautam. Whether I'm audible?
Yeah,
Gautam?
please. Yes, sir. Yeah, please.
Whether I'm audible, Gautam?
Yes, sir.
Yeah.
Yes, sir. Please.
Eminent resource person, CS TP Sridhar and Sri Parindatia, respected Galaxy of Past Chairman, Dynamic Committee Member, Immediate Past Chairman CSS Naik sir, Secretary CA Prasanna Shadai, Chairman of SICASA CA Gautam Pai, senior members from our fraternity, colleagues, friends, aspiring CS, ladies and gentlemen, good morning to you all. How good you are in any subject, unless you maintain it, you may lose it. For instance, you might be having good physics, but unless you maintain it day to day by making exercises, so your good physics you will lose over a period of time. Like the same way, and though you are intelligent, if you do not maintain the same, so you may lose the control over the subject. So now, what are the sources? How we can develop our expertise? So we can read the books. We can tell our juniors or students to prepare, write notes and present it to us. But in that, some difficulties are there. Firstly, because of the vast subject, it may not be possible for us to update everything. And again, unless we have some control over the subject, it may not be possible for us to ask our students or juniors to prepare notes and give it to us. So I think this seminar, attending this seminar will update us on day-to-day basis. Members, today we are going to attend two seminars, as our as Gautam Pai has already told. In the beginning, we'll be attending the seminar on the regulations for foreign direct investment. You may come across NRI clients on day-to-day basis, and they might be asking you, can they make investment in India? If they can, whether pre-approval is required, again whether they can repatriate the sources from India. So you may also come across, your client might have opened one, formed one private limited company, and he wants to collect some investment from the NRIs, or even he may ask whether NRI can become a director in a company. To resolve all these doubts, we thought we should have a seminar on the same. Today we have eminent resource person TP Sridhar, who is also fondly called TPS. He is a very senior member of a company secretary, He is into practice from last 2 decades. He is also, we can also, he is a very simple person. We can also consider as a Google. He has opened a group in the Telegram. He has opened a group in Telegram, and he has a passion to share his knowledge, and he answer all the doubts of the group members instantly. That is the capacity of our today's resource person. Sir, today, so we are very fortunate. He is there with us. Sir, I would like to welcome you on behalf of our Mangalore branch, and Mangalore branch will be very grateful to you, sir.
Thank you, gentlemen. Thank you so much.
Yeah. Today we are also going to have one more session on a cryptocurrency, and it is also very important, very interesting subject, because you will be knowing our former then finance minister Jaitley want to have a ban on this cryptocurrency, and also we would like to know whether any cryptocurrency is whether a asset, whether on the sale of same, whether it attracts capital gains or whether it attracts income from other sources. All those doubts we have, again from the legality of the subject. So today we will be having, we have one more resource person. I think he may join us later, because that will be our second session. And we are very lucky. He is a very knowledgeable person in this subject. That is Sri Parin Latia. He is also a writer too, and a successful entrepreneur. We are very lucky, and I would like to welcome him too, but he may join us a little while from now. Members, already we have discussed during our last seminar. We are going to come up with the workshop on foreign trade policy. Again, it is introduced by our vice chairman during the last seminar. It's the first of its kind in all over India, and many members will be joining from all over India. This might be very popular workshop. We have kept it open, and you can join, and you can join the workshop for a benefit of you members. Like the same way, we are going to come up with one more seminar on Monday, that is on income tax, and subject of the same will be changes in reassessment procedure, post assessment, and penalty provisions under income tax act. Members, already we have informed you, we have made an appeal also. We are coming up with the appeal that to raise some funds for the purpose of keeping commitment to serve the humanity. And I would like to tell you that we are the very fortunate amongst the professionals. So this is the time for raising our image in the society. We can make some good deeds in the society, to not only to raise our image, but also to serve the community. That's for we have come up with one appeal, that is we have created one fundraising in the Keto, which we are going to release in our group. We request all you members to contribute to that liberally, so that we can raise one respectable amount, and we can come up with some good deeds. So before to conclude, I also would like to welcome you all members and aspiring CS. I hope you will enjoy these 2 seminars. Over to MC Gautam.
Thank you, sir. Let me now formally introduce the speaker of the first session, CSTP Sridhar sir. As the chairman sir rightly told, he is fondly known as EPS in the professional circles, and is a commerce graduate from the University of Madras and a fellow member of the Institute of Company Secretaries of India since 1995. He has over 2 decades of work experience in various corporates, including 5 years of post-qualification experience in listed company and over 20 years as a practicing company secretary. He has been providing professional services in Companies Act as well as FEMA for both domestic and multinational companies. His expertise include advising on corporate affairs with particular emphasis on company law and allied acts on a constant basis, advising on FEMA regulations and liaison with RBI for approvals for FDI, ODI, ECB, compounding, etc. Due diligence audit under foreign exchange management, and also lectures in SIRC of the Institute of Company Secretaries of India, as well as Bangalore and Mangalore branch of ICAI. Sir, I once again, on behalf of the branch and all the Mangaloreans, welcome you to this session and hand over the session to you.
Thank you, sir.
Yes, sir.
Gentlemen, is my screen visible?
Yes, yes, sir.
Okay. Thank you for that nice introduction. Thank you so much. As the first speaker told you, I do have a exclusive group on foreign exchange management. Our group is exclusively for knowledge sharing on foreign exchange management. Because of the volume and because of the number of members, I had to shift from WhatsApp group to a Telegram group. People who are interested in joining may please send their request from their Telegram account to me. I have this number displayed here so that you can be made a part of that. And all your queries, there are a lot of eminent professionals there, chartered accountants, company secretaries, lawyers are there. Definitely your queries will be answered probably within 24 hours from the time you post your queries. With that in background, let me start. And I thank the Mangalore chapter for the excellent opportunity to meet you learned professionals and share my knowledge with you on the foreign exchange management. I'm going to share with you that whatever little I know and based on the things that I've learned over a period of time with my experience. Thank you, gentlemen. Let's get started. Any legislation will have a history. Knowing the history is very important before you start learning. Because you should know why that enactment came into force, when it came into force. You should know about the history, the purpose for which that enactment had been made, and its applicability. Right? For example, in this case, when you take the foreign exchange management, it was FERA. The original avatar was under the Defense of India rules in 1939. Then, when you walk back into the history, India became independent in 1947. When India became independent, the Parliament had enacted various legislations, and one among them was the Foreign Exchange Regulation Act. The Foreign Exchange Regulation Act was very draconian and it was very conservative. It was a time when the foreign exchange was so scarce that the act was enacted mainly to conserve resources. And in 1947, from 1947 to 1973, the Foreign Exchange Regulation Act was there. And in probably just before 1973, the government of India formed a special committee to study on the leakage of foreign exchange through over and under invoicing. That committee studied the entire FERA and came back with a lot of the recommendations. And thus, the Foreign Exchange Regulation Act 1973 was born. In 1973 was more draconian than the 1947 Act. From 1973 to 1999, the Foreign Exchange Regulation Act was there. But this was the time when India really started growing, when the foreign exchange reserves improved substantially. I think many of the senior people would appreciate, probably in early 90s and late 90s, early 90s, the open sky policy came in. A lot of the doors were open, flush doors were open for the foreign investors to come in. Foreign multinational companies came into India, like Coca-Cola and others, to do business. Thus, the foreign exchange reserves increased substantially. and the government thought it was time that we manage the resources as against regulating the resources. Hence, the Foreign Exchange Management Act was introduced in 1999. This act, which you are going to go and study, understand about this, was effective from the first day of June 1999. Purpose. For what purpose this act was brought in? An act, there are three different purposes for which this legislation was brought in. Three major purposes. One, to consolidate, amend the law relating to foreign exchange, because they wanted to consolidate and amend and make the external trade and payments much easier. And third objective was to promote the orderly development and maintenance of foreign exchange market in India. There are three major objectives for the enactment of this legislation: to consolidate and amend the law relating to foreign exchange, to make external trade and payments much easier, to promote orderly development and maintenance of foreign exchange, were the purposes for which the enactment was brought in. Can I proceed?
Yes, sir, sure.
Okay. When you understand about the history, the purpose, then applicability. As professionals, we should know how it is applicable, to whom it is applicable. So applicability becomes very, very important, right? See, this enactment called Foreign Exchange Management Act is applicable to the whole of India, including the state of Jammu and Kashmir. If you would have understood, many of the enactments, many of the legislations are not applicable to the state of Jammu and Kashmir, whereas the Foreign Exchange Management Act applies to the whole of India, including the state of Jammu and Kashmir. And it applies to all transactions that has got at least an international dimension or flavor. The peculiarity of this act is that it has got an extraterritorial jurisdiction. That means it is not applicable only to India or Indian law of land in India, but it also applies to the branches, offices, agencies that are established outside India and controlled by person resident in India. That means you are making, for example, let's say a company, private limited company, makes an ODI elsewhere, right? And that company violates some of the FEMA provisions. Even though that entity is outside India, FEMA becomes applicable. That's why it's called an extraterritorial jurisdiction. This is very important. Then any contravention that happens on foreign exchange management, even though it is outside India, it becomes applicable. The second peculiarity of this act is that FEMA is an additional law. That means you will have to comply not only with the foreign exchange management, but also the basic law that is applicable. Say, for example, when there is an investment happening in India from a country outside India, if it is a private limited company, then the Companies Act will have to be complied with. If it is a partnership firm, the Partnership Act will have to be complied with. If it is an LLP, the LLP Act will have to be complied with. Over and above this, the foreign exchange management will become applicable. It is not enough if you comply any one. Both will have to be complied with, including the Income Tax Act, wherever it is applicable. Right? Can I move on? Is it clear, or am I fast? Am I clear?
Yes, sir. Yes, sir.
Yeah. Can I move on?
Yes,
Yes, sir. Yes, sir.
See, FERA was a regime till 1999. When 1999, FEMA was introduced, and FEMA has been constantly liberalized over a period of time. FEMA, what was in 1999 and FEMA today, you see a world of difference. There is a lot of liberalization. Similarly, from FERA to FEMA, the whole object was to liberalize. What kind of liberalization? The regulation, Foreign Exchange Regulation Act became Foreign Exchange Management Act. From a regulation perspective, the government thought it has to be a management perspective because the resources were in plenty. instead of conservation, because and under Faraday's, the foreign exchange resource was not there at all. So they had to conserve resources. Now they are facilitating resources. From control mechanism to regulation mechanism, from all the offenses that are criminal in nature in FERA have become civil in nature under FEMA. Any offense was not, none of the offenses are compoundable under Foreign Exchange Regulation Act. That means imprisonment was one of the solutions, whereas almost everything under the Foreign Exchange Management Act has become compoundable. So it has completely liberalized. It has completely liberalized from FERA days to FEMA days. It was complete. In fact, in FERA days, the industry was at the mercy of the regulators. When you had to travel abroad, people will have to go and stand in long queues in Reserve Bank of India for their foreign exchange notes and currencies that they had to travel, take it abroad. I have also heard of people saying a very popular actor, actresses used to stand in queue to get their foreign exchange to travel abroad. Today, that's not the case. You walk into any bank and you can exchange or you can give your INR and take foreign exchange. That's very simple. It's become so simple. So facilitation has increased. Foreign exchange reserves have improved substantially. Right? So it has completely got liberalized. But the more liberalization you get, reporting also has become mandatory. Every transaction, every foreign exchange transaction, every transaction that has got a foreign exchange flavor or a dimension definitely requires reporting. Either you report it directly or indirectly. If a reporting is not done and transaction is still happening, there can be only two things that can emanate. One, you have contravened the provisions of law, or it is an hawala transaction. There are only two things. So any transaction, you name the transaction, it has to be reported either directly or indirectly. You are able to understand what I'm saying, or should I reduce my speed, or how is it? Can somebody respond?
No problem, sir. You can continue, sir. Like
or can I reduce my pace for?
No. Your face is also visible, and your pace is also visible, sir.
That's wonderful. That's wonderful. That's wonderful. A small letter.
And at the end, we will have interface also.
That's fantastic. One small letter makes a huge difference. Right. Reporting. Every transaction has to be reported. Every transaction has to be reported. Be it a capital account transaction or a current account transaction, reporting is mandatory. Either you report to Reserve Bank of India directly, or you report to Reserve Bank of India through the authorized deal. Because all current account transactions have now been decentralized, and you report to the AD Bank, and through AD Bank it reaches RBI. So reporting is one of the major things of Foreign Exchange Management Act. Now, when you say reporting, we are talking about two transactions. One is a capital account transaction, other is a current account transaction. If you look at FEMA as a whole, almost every transaction that is happening can be categorized either as a current account or a capital account. Very simple. They fall under any one of those two baskets. Capital account transaction or a current account transaction. Let's understand what a capital account transaction is. Transactions that alter the assets and liabilities that are lying outside India and is owned by a person resident in India. Basically, as chartered accountants, you'll understand anything that alters your balance sheet will be a capital account transaction. So there are two things that you look: whether the assets or liabilities is getting altered. Is there an increase or decrease in assets, or if there is an increase or decrease in liabilities? Either way, that amounts to alteration of the balance sheet. And the location of the person, whether that person is located in India or outside India, matters the most. Right? So if there is a cross-border ownership and location of asset, then it becomes a capital account transaction. Right? So the location where that owner is located. First question is whether the assets and liabilities are getting altered. Two, where the person is located. These are the two questions that we need to address before we get into that. What are the examples of a current capital account transaction? Foreign direct investment. Foreign direct investment, the asset is in India, whereas the owner is outside India. It's a capital account transaction. Overseas direct investment, the owner is in India and the asset is outside India. When you make in the first case, when if a company receives investment from outside India, the asset is located in India. The asset of the person overseas, for him it is the investment. Though for the company, investee company, it could be shown as the liability side, but for the investor, it is the asset. So the asset is lying in India and I'm sorry, and the owner is elsewhere. So it becomes a capital account transaction. Overseas direct investment is a reverse of what of foreign direct investment. There is also a capital account transaction. External commercial borrowing. The borrower is here, the lender is outside India, then it is a capital account. And immobile properties, a person buying or selling immobile properties in India, the asset is in India, the owner or the seller or the buyer is outside India. So these are called the capital account transactions. Having said what the capital account transaction is, the other kind of transaction is current account transaction, because the entire transaction can only be two. Either it is a capital account transaction or it is a current account transaction. When you know what a capital account transaction is, you should also know what a current account transaction is. There are two different types. What is not a private company is a public company, and what is not a public company is a private company. Similarly, any transaction that does not fall in the basket of a capital account nature is a current account transaction. To put it in very simple terms, if the asset alters the profit and loss account, then it becomes more or less of a current account transaction. Any cross-border transaction that is not a capital account transaction is a current account transaction. Examples are payment made for imports. When you import, you send the money out, it is a current account. Payment received for export, we have already exported the goods and payment is now being received, then it is a current account. And other business service transactions fall under the category of current account transaction. And initially we discussed about reporting. Any transaction is reportable, you'll have to report. Then how does one report about the capital account transactions? Capital account transaction is any corporate, there are two types again. Reporting is of two types. Either you report based on a corporate action or you base on the other is your regular annual reporting. It's like this. Whether or not the company is doing business, whether or not there is any activity in the company, whether or not he has a profit and loss account, the balance sheet will have to be prepared by chartered accountants. It has to be signed and it has to be filed with the income tax department and the registrar of companies. Whether or not the company is doing business, that is immaterial. Every year you will have to prepare a balance. That's a ritual to be done. So those are annual transactions or does not require any corporate action. But where there's a corporate action, what happens? Like when there's an allotment of shares, you file FCGPR. This is a way of reporting. When there's a transfer of shares from non-resident to resident or a resident to non-resident, then you file something called as FCTRS. This again is a capital account transaction and reporting happens. When the Indian entities borrow money from abroad, there's a form ODI file. That means there's a corporate action, it's a capital account transaction. External commercial borrowing. When monies are borrowed from outside India and then we file something called as external commercial ECB. All these things are capital account transactions that goes to and that has to be reported. Assuming for a company which has got an FDI and has no transaction during the year, even if there is no transaction, even where there is no foreign exchange transaction, even there is no, they are not doing any business, as long as they have an FDI, the company will have to file foreign liabilities asset statement every year before 15th of July. Where the company has got an ODI, where they invested their money abroad, then the annual performance report will have to be filed before 31st December every year. So these two are yearly reportings, and what we saw earlier was based on the corporate actions. Clear? Can I move it? Okay.
That's it.
Yeah. No, I have a small request here. If people have any doubt, they can stop me and probably ask questions. I'll be too happy to answer them. They can stop me there, then and there, and I will stop this and answer your query and then take it forward from there so that you don't forget, because the entire webinar is tailor-made for people, chartered accountants like you, to share knowledge. So your doubts should be clarified then and there. Only then the object of the entire webinar is fulfilled. People have taken great pains to organize this for the knowledge to be transferred. So any doubt, please stop me there. I will answer your question. If in case I'm not able to answer, not that I know of everything, there are a lot of items where matters which I may not know. I will go back, do my homework, and probably come back to you. You can write a mail to me. I'll come back to you. Not a problem. Okay. So far, gentlemen, you have any questions? Any doubts to be clarified?
Gautam, can you moderate, sir? For easy purpose, we thought that because it is a webinar, no?
Yeah.
So, because we thought that at the end, the members will be, because members, we have made them mute. They cannot ask questions, so they can only put the doubts in their chat boxes. So at the end, after the seminar, we'll be keeping some time, 15 minutes or even more also can be spared for the same. So for the purpose of clarifying the doubts only. So Gautam will be moderating the same. So now suppose in the now itself, if we ask the question, because they can't ask any doubt, they can only chat in that particular chat boxes. That's why I don't know how comfortable they will be to raise the question. So that's why
that is possible, sir. They can unmute and do it, but the point is, how do we want it? Either we do it at the end, one shot, we answer everybody's question, or we.
Sir,
it is better to have a question answer at the end, sir.
Fantastic, sir. Sir, it is listener's choice, sir.
Last 20 minutes, you can earmark for question answers.
Exactly.
And only committee members are allowed to chit chat, and all others are allowed to chat.
That's fantastic, sir. Because it is, as you say, it is a listener's choice. Because the participants will have to be comfortable.
Yes, sir.
Okay. So however they want, I'm happy to serve them.
No problem.
Okay. And we are hearing you also, sir. We'll be hearing you, focusing on the subject. Only thing is, this is a webinar, no? Unless unlike a seminar, so it's not possible to raise the hand in the
Chairman, please let the speaker continue.
Okay. Yeah.
Okay. When we talk about we have discussed about the reporting requirements, then let's get into the definition part. Often we have heard of the term foreign direct investment and foreign investment. Yes, they are different. They sound to be the same. Foreign investment and foreign direct investment, they sound to be the same, but actually there is a subtle difference between them. I'll tell you. What is a foreign direct investment? Investment in a capital instrument. This is very important. Foreign direct investment is an investment in a capital instrument by a person resident outside India in an unlisted company. If an unlisted company, it could be a private company or it could be a public company. When a foreign direct investment is received by an unlisted company, then there is no cap. That means they can receive, subject to sectoral caps and other guidelines, they can receive their entire capital from abroad, right? This is foreign direct investment. What about in case of listed companies? Any investment, foreign direct investment, more than 10% in a listed company is treated as foreign direct investment. Up to 10%, it is, though the monies come from abroad, it is treated as a domestic investment only. There is a reason to this. Because every transfer, it is between a resident and a non-resident, or a non-resident selling it to a resident, it has to be reported to RBI through the authorized dealer. In case of listed company, what happens? If anybody is going to have a guy sitting abroad is going to buy 10 shares, then a reporting has to be done. If he sells 5 shares, again reporting has to be done. Because every transaction has to be reported. To conserve thing, what the government has thought is, if it is more up to 10%, they thought it is insignificant. So up to 10%, even if it is a foreign direct investment, it is treated in a listed company, is treated as domestic investment, and anything beyond that is treated as a foreign direct investment. And only when the foreign direct investment exceeds 10%, reporting becomes mandatory. Otherwise, all these listed companies will have an exclusive department only for reporting on foreign direct investment, especially on transfers. Right? So this foreign direct investment is an investment in capital instrument. This is very important. The word capital instrument is being used in foreign direct investment. This is very important. Right? So what is the other term? This is called foreign investment. Investment made by a person resident outside India on repatriable basis in capital instruments of Indian companies or the capital of a limited liability partnership. That means all corporates can receive foreign direct investment, and limited liability partnership can receive only foreign investment. This has got a far reaching consequences, right? Because when you go for an external commercial borrowing, as it is, there is no capital instrument or shares being issued in LLP, they are not entitled for external commercial borrowing. So the difference between foreign investment and foreign direct investment is in terms of unlisted companies, it is the security. If the securities are issued, then it becomes foreign direct investment, which happens only in private limited companies, public companies, and listed companies. Foreign investment is more for a limited liability partnership. Then, investment on repatriable basis means the sale or maturity proceeds of which net of taxes are eligible to be repatriated, taken outside India. So we will understand what repatriation means. That means the money that is coming from abroad is invested in the company, and then once it is liquidated or sold, the investor should be able to take it back to the home country, net of taxes. So this is called repatriation. So investment that is coming into India on repatriable basis can be either foreign direct investment or a foreign investment. If it is for LLP, it's foreign investment. If it is other companies, it's called foreign direct investment. That means today with the liberalization, every sector, you name the sector, you can have foreign direct investment in that, barring these entities, these businesses where foreign direct investment is not possible at all. Lottery and gambling business. Say, for example, I'm not very sure now, Tamil Nadu had barred lottery business long back, while Kerala was having it. I don't know about the present situation. I don't know about Karnataka also. Karnataka, do they have lottery there? Lottery tickets being sold? I don't think so. So whether the state allows it or not, you cannot have a foreign direct investment for the business of doing lottery or gambling. Chit fund and nidhi companies. Chit fund and nidhi companies primarily meant for the local area, local people, maybe for that particular locality or the area. So there you can't have a foreign direct investment. Trading in transferable development rights, which is related to real estate or construction of farmland. You can't have a real estate business or construction of a farmland. You cannot manufacture cigars, roots, cigarettes, everything with foreign direct investment. Foreign direct overseas foreign direct investment cannot happen in companies carrying on the business of manufacture of cigars. All these foreign brands of cigarettes that are being sold are not manufactured in India. They are imported and sold in India. Or they are manufactured by companies which does not have foreign direct investment. Using foreign brand names, they manufacture. That's how foreign cigarettes are available. Either they are imported or they are manufactured in India using the foreign brand name, but such companies do not have any foreign direct investment. Sectors not open for private participation, private sectors. That means railway. Railway, you can never invest any amount of no private sector is allowed in railways, atomic energies. So those are entities or sectors where foreign direct investment cannot happen. So lottery business, chit fund business, TDR business, real estate for construction of farmland, manufacture of cigarettes, and railways and atomic energy, these are the areas where you cannot have foreign direct investment at all. You cannot even approach government. You cannot even do this business in the approval route. You cannot take your application, file an application for foreign direct investment in these sectors. It will be outrightly rejected. Right? Barring these entities or barring these industries, FEMA has become so liberal that you can have foreign direct investment almost every sector possible. Maybe some sectors come with a sectoral cap. Maybe some is allowed up to 24%, some is allowed up to 74%, and something like that. And there are also conditionalities that have to be complied with. Right? That is all the sectoral caps, all these performance indicators are given in Schedule 1 to the non-debt rules. If you go through the Schedule 1 of non-debt rules, you will thoroughly understand what are the sectors that are open, to what extent foreign direct investment is allowed, whether it is government approval route or it is an automatic route. Everything is given clearly there in Schedule 1. When we talk about prohibited sector, though we are talking about the foreign direct investment as a whole, in that there is a particular pocket which talks about prohibited sectors. When I talk about prohibited sector, when I cannot receive money, foreign direct investment from abroad, I thought it is pertinent to tell you what are the areas where you cannot make it. That is, a private or a public company or individual cannot make investment outside India. There are prohibited sectors for ODI. Prohibited sectors for FDI are these: lottery, chit fund, trading, real estate, TDR, cigars, and sectors not open for public. These are sectors where FDI cannot be there. Similarly, these are sectors where ODI cannot be there. If somebody is doing real estate business abroad, you can't go and invest. If somebody is doing a banking business abroad, we cannot go and invest. These things cannot happen without the prior approval of Reserve Bank of India. So these are the two don'ts as far as the FDI and ODI is concerned. Now, we have been talking about investment. We have understood about the history. We have understood about the applicability. We have understood about the geographical the purpose of the enactment and what is FDI, what is FD. We have tried and understood by and large. I've given you a bird's eye view of the entire thing. Now, when you're talking about investment, then you should also talk about eligible. Who can invest? Not that everybody can invest, right? A non-resident entity can invest in India subject to. A non-resident entity can invest in India subject to the FDI policy and sectoral cap. Except for the prohibited sector, no one can invest. That's ruled out. But there is an FDI policy. Every 5 years, Government of India comes out with a consolidated FDI policy, giving what are the sectors where investment can happen, to what is the extent to which investment can happen, who can bring in the money. All those things are coming under consolidated FDI policy, right? So subject to the FDI policy and sectoral cap which are given there, any non-resident entity can invest. Entity from countries which share its land border. This is the latest development. I think this was somewhere in last year, April or May, or during the COVID or something. Entities from countries which share its land borders with India cannot invest in India except with the prior approval of the government. I think there are around 7 countries where we share land borders with land borders. I make it very clear. If we are sharing land borders with countries, such countries cannot invest in India, independent of the amount. It could be 10 rupees, it could be $1, it could be 100 million trillion dollars. That's immaterial. When the investment happens from countries, or when the investment is coming in from countries which are sharing the land borders, then such investment cannot happen without the prior approval of Government of India. I think the Ministry of Home Affairs is also involved in granting its approval. Right. So this is the overall. Now let's go into the specifics. To understand about the foreign direct investment, what should I read? Where should I start? What should I understand? Right. The first thing I would say that you should to start with, to understand, they'll have to go through the consolidated FDI policy. They'll have to go through the consolidated FDI policy. This is point number 1. That is, the policy decisions are given there. And then the operational matters are the rules that are governed are published by Reserve Bank of India. So to understand about FDI, one has to go through the Foreign Exchange Management Non-Debt Instrument Rules 2019. There are a few amendments that are also coming. So one has to understand the Foreign Exchange Management Non-Debt Instrument Rules 2019. There are various schedules given in that. One has to understand those schedules. Any transaction that is happening, you must first understand what is the kind of transaction. That's very important. Segregate them, whether it is a capital account or current account transaction, and understand the transaction. And based on the transaction, you should understand under which schedule it will fall under. So if you understand these schedules, at least the names of these schedules, you will be able to identify any transaction that where does it fall under. And you go to that particular schedule, understand that schedule, the transaction and the compliance would become very, very clear. Right? See, there is why at all we should understand the entire thing is, as chartered accountants, as company secretaries, whether we are in employment or whether we are in practice or whatever we do, we need to advise client in a holistic manner. That means in terms of the applicable income tax, applicable Companies Act, applicable FEMA regulations, everything will have to be, we will have to look at it in a holistic manner.
Namaste, Heli. Arame alla.
Okay. We will have to go into this, understand the whole thing in a very, very holistic manner. So when you advise a client on income tax and the Companies Act or the LLP Act, where there are transactions that has a foreign cross-border transaction, where the transaction has got some foreign exchange involved, where there is a cross-border investment happening, then we need to advise the client on the compliance with foreign exchange. Please understand one thing. Compliance is very easy. Non-compliance is very, very expensive. We just can't. I've seen many people. Okay, sir, we'll just cross it when it comes, or let RBI raise their issue, then we'll cross it. It doesn't work. For the time being, it will work. It's like traveling in a train without a ticket. For the time being, it will be good, but when it is going to bounce back, when the company is pulled up, the severity will be very big. You'll have to be very careful there. So when as professionals, when we advise a client, my opinion is a holistic approach would be better. That's the reason we try and understand the Companies Act, the Income Tax Act, the accounting standards, and whatever needs to be done in accounting, and maybe most of the applicable laws. FEMA is one such. Coming back to this thing, foreign exchange management, when you go through the non-debt instrument rules, it gives you the entire picture about the foreign direct investment. And there are around 10 schedules. If you are able to understand a transaction, and those transactions will definitely fit into one of these 10 regulations or 10 schedules. Once you understand which schedule, I'm sorry. So understanding non-debt rules is very, very important. That it is in non-debt rules. They are talking about FDI, FD, non-resident, resident, cross-border transaction. Everything is being dealt with only in the non-debt rules. Now, let's get into the investment part of it. Investment by non-resident. This is one area where I get at least a couple of calls every day on foreign exchange management. At least minimum one or two people call me asking for clarification on how it is to be done, where does it fall under. So my basic, my opinion is that one has to understand the transaction thoroughly. When the transaction is under or proposed transaction thoroughly, for us to advise the client. So for which we should understand how, in case of a transfer, let's see how to understand this and how to take this forward, how to advise the client, or how do we do it. Investment by non-resident. Investment by NRI or OCI may make investments as under. So an NRI or OCI can make an investment as a. Gentlemen, just give me 1 minute. With your permission, I'm just stopping my video for a minute. No? I'm sorry, gentlemen. No, these days, suddenly some SMS or calls keep coming continuously. No, because there's some emergency. So I thought there was some emergency. I thought there was a message. I had to look into the message. I'm sorry about it. Sorry for the break. Let's continue. So an investment by NRI or OCI may make investments as under. An NRI or OCI. NRI is non-resident Indian, or OCI is overseas citizen of India, can invest on repatriation basis in equity instruments of listed companies and other securities subject to the terms and conditions prescribed in Schedule 3. So if you look at Schedule 3, it talks about investment by NRI or overseas citizen of India on a repatriation basis. That is, repatriation means where the monies can be taken back to the country of origin. So the conditions are purchase or sale has to happen through a designated branch of an authorized dealer. It has to come through the authorized dealer to a designated branch. Only then it is permitted. You cannot bring in money through full-fledged money changers, or somebody can't bring in dollars where they invest. Those things cannot happen. The total investment of an individual NRI or OCI not to exceed 5% of the total share capital of the company. That means NRI or OCI cannot exceed one single NRI or one single OCI, overseas citizens of India, cannot invest more than 5% of the total paid up share capital of a listed company. The total, sorry. The total holding of all NRI or OCI not to exceed 10% of the. See, if there are multiple NRIs, if there are some multiple OCIs, all of them put together can be up to 10% of the total paid up share capital. Right? So, if it is a single person, then it is 5%. Where there are more than 1%, it could be up to 10%. That the advantage here is where the company can have a special resolution to that effect. The total investment that can be received from all the NRIs and OCS can exceed up to 24%. This special resolution is mandatory, right? So it is not enough you comply with foreign exchange management. You will also have to comply with the Companies Act. 117 will have to be complied with. Can invest on non-repatriable basis. See, what is the difference between repatriable and non-repatriable? Repatriable is giving a loan. So when I receive a loan, I will be definitely bothered about the amount I receive, the interest I am going to pay, the tenure, the penal provision, penalty clauses that are applicable, where if I don't pay, everything will be, I'm bothered. When it is a gift, I don't have to bother anything because the donor is not going to take the money back. Similarly, all these things have complications, or all these reporting, severity, all these things is there only on a repatriable basis. When it is non-repatriable, that is, money comes into India, it is not taken abroad, then you don't have a problem. Can invest on non-repatriation basis in equity instrument of an Indian company or other securities, or contribute to the capital of a limited liability partnership or a firm or a proprietary concern in a manner and subject to the terms and conditions specified in Schedule 4 to the Foreign Exchange Management non-debt rules. So there are some conditions that has been specified in the Schedule 4 to the non-debt rules. See here, all these things will be treated as a domestic investment. That is the reason. So if the money is received from an NRI or OCI, and if they are not going to take back the money, it is going to be permanently resident in India. The investment is going to be permanently in India, and if there is no question of repatriation, then such investment will be treated as a domestic investment. In many cases, I don't think even the bankers through which, authorized dealer through which this money is coming in, will even issue FIRC. But here the advantage is, since it is on a non-repatriable basis, I don't think we need to report this to Reserve Bank of India. But my personal experience and suggestion is, it's better that we report to Reserve Bank of India in a plain paper or in the letterhead of the company, giving the details of allotment, giving the details of money that has come in, saying that it is on a non-repatriable basis. Because the investor is going to be a non-resident. He is going to be a non-resident Indian. He is going to be a person of Indian origin. That has to be specified. So the investment is received from abroad, no reporting is required because it is on a non-repatriable basis. However, my suggestion, my experience is that it's better that the investee company reports this to the concerned Reserve Bank of India in their letterhead, giving details of the investment and giving details of the NRI who has made the investment along with the pre and post shareholding pattern. This will help the investee company on a long run. Right? So let's go to the next slide. Transfer. The most complicated and area where there's a lot of doubts that is arising is transfer of equity shares. I think many practitioners in this group, many chartered accountant practitioners would have definitely felt had this difficulty of advising people on transfer of equity shares, the compliance requirement when there is a transfer. Can I go ahead?
Yes, sir. Yes, sir.
Yeah. Repatriation basis to person resident outside India. An NRI or an OCI holding equity instruments of an Indian company or units on a repatriation basis in accordance with these rules may transfer either way of sale or gift or such equity instruments or units so held by him to a person resident outside India in compliance with the following. That means if he is holding the share, if an NRI or OCI is holding the shares on a repatriable basis, and if he wants to sell the shares to a person resident outside India, NRI may also be outside India. If an NRI wants to sell the shares to a person resident outside India, then the following will have to be complied with. Prior government approval shall be obtained for any transfer in case the investee company is engaged in a sector which requires government approval. You go back to Schedule 1. When there's a problem like this, when there's an issue like this, we go back to Schedule 1 to find out who are the people, what are the sectors where government approval is required, what are the sectors where 100% automatic route is allowed. So you find out where this particular investee company is engaged in, what business they are engaged in. So if they are engaged in sectors that require government approval, transfer of shares will automatically demand government approval. So when there is a transfer of shares from NRI or OCI to a person resident outside India, then you need to go to, one of the conditions is to go to the government, have a government approval for before effecting such transfer. Where the acquisition of equity shares by an NRI or OCI are resulted in a breach of, see, if there is a transfer of shares and there is going to be a breach of applicable sectoral caps, by he has acquired it, but there has been a breach of sector, because what is sectoral cap? The sectoral cap is the capital up to which a particular industry can have. Where has it been said? This has been said in consolidated FDI policy and in non-debt rules also. If you go back to the consolidated FDI policy, it gives you industry-wise sectoral caps. On this particular sector, what is the cap, foreign direct investment that they can have, whether that such investment is permitted with the government approval or without the approval, whatever it has been stated. And the conditionalities have also been given there. So if an NRI or OCI where the acquisition of equity instrument by an NRI or OCI are resulted in a breach of applicable aggregate NRI or OCI limit or sectoral limit, the NRI or OCI shall sell such instrument to a person resident in India eligible to hold such instrument within the time stipulated by Reserve Bank of India, and the breach of such aggregate sectoral limit on account of such acquisition for the period between the acquisition and sale, provided the sale is within the prescribed time, shall not be reckoned as a contract. That means accidentally I cross a yellow line. So I come back. So when I accidentally cross a yellow line, and the government of India says that no, they give you time for you to sell, so the excess share will have to be sold. Their transfer, you'll have to transfer those shares to a resident individual who is eligible to hold these shares. And when the crossing of that yellow line, by you for that specified period will not be treated as a contravention. That means it is not a default. You can definitely come back and no compounding proceeding will be initiated against you. It's only a temporary phenomenon. Accidentally you have acquired shares and such OCI or NRI has to dilute his holding up to the sector. This is only for sectors where there is a sectoral cap, and it has to be sold immediately within the timelines given by Government of India, Reserve Bank of India. And if you sell it within that time, it will not get covered, it will not be a contravention. Let's look at non-repatriate. Non-repatriate basis to person resident outside India. An NRI or an OCI or an eligible investor holding equity instruments of an Indian company or units of on a non-repatriable basis. That means the investment has come in, shares or securities have been allotted, and it is not going to go back. The sale proceeds are not going to be repatriated. It is not going to be sent out of India. If an NRI or OCI is holding instruments on non-repatriable basis, may transfer the same to a person resident outside India by way of sale, subject to the adherence of entry route, sectoral cap, or investment limits, pricing guidelines. That means when a non-repatriation is becoming repatriable shares, you understand what I'm saying? An NRI or OCI is holding the shares on a non-repatriable basis. That means the shares, the sale process cannot be taken out of, need not be taken out of India. Now, the sale is happening to a foreign national, to a person resident outside India. Automatically, he will invest only in on a repatriable basis only. That means he will want, when he buys the shares, he will definitely want to take the sale proceeds later outside India. So if we, from a non-repatriable instrument is becoming a repatriable instrument. If such be the case, you will have to definitely adhere to entry route restriction. That is, if it is a government route or non-government route, that has to be complied with. Sectoral cap limits will have to be complied with. Pricing guidelines, that is valuation by a chartered accountant, registered valuer, will have to be done. And addendum, if there are any other condition for that particular sector, then those things will have to also be complied with, because the non-repatriable share is becoming repatriable. The moment it becomes repatriable, everything starts attracting the transfer. See here, I would like to tell you about something about the thumb rule of FEMA. As far as FEMA, this is very, very important. In fact, people, if there are any students, they can probably write it down also. The thumb rule. Thumb rule is advantage India. That is, when a security is being sold, you have to do a valuation, and the sale price cannot be lesser than the value price or the fair value. When I sell a product, I cannot sell it lesser than the MRP. MRP is nothing but the valuation price, the fair market price. When I sell, the consideration I receive cannot be lesser than the MRP or the fair market value. Similarly, when I buy, that is, when I buy shares, the money that goes out of India cannot be more than the fair market price when I buy. Hope I am clear on this. When foreign exchange goes out of India, it has to be equal to or lesser than the fair market price. That means when I buy shares of an Indian company from a foreign national or an NRI or OCI, an Indian resident is buying shares, then what happens? I'll have to pay money and then buy those shares. That is, I need to purchase foreign exchange and give it to somebody to buy these shares. So the money I pay has to be equal to or lower than the fair market price. That means money is going out of India. Typically, my foreign exchange reserve is coming down because of this transaction. The other advantage to India is when foreign money comes into India, when there's a foreign direct investment happening in a company, the price at which allotment can be made can be equal to or more than the fair market value or the valuation price. So when the money comes into India, when dollars comes into India, it has to be equal to or more than the fair market value. When the money goes out of India, it has to be equal to or less than the fair market value. This is the thumb rule as far as the pricing or foreign direct FEMA is itself concerned. The next thumb rule is what is not expressly permitted in FEMA. All other things, either they are prohibited or we'll have to have an express permission, written permission from Reserve Bank of India or specific permission from Reserve Bank of India. The other way is, if you look at the Companies Act, what does it say? What is not expressly prohibited is permitted. If there is no specific prohibition, then it means it is permitted. It is a reverse in FEMA. What is permitted alone is permitted. Whatever is not permitted, whatever is not expressly said, either you approach the authorized dealer or you approach Reserve Bank of India or the Government of India to take an approval and then do it. These are the two thumb rules are: one on the pricing, where the dollars foreign currency comes in or foreign currency goes out. That is one thumb rule. The other thumb rule is what is not expressly permitted cannot be taken into account. You will have to, for all other areas, we'll have to go to approach RBI or the Government of India for approval. These are the two thumb rules. I think if there are any students, probably they can make a note of this. This will be very useful for you. The next largely confusing area is gifting. Gifting of shares. Sir, many people, in fact, there have been cases where people ask me, sir, it is my own son, I'm going to gift it. What is I saying? I've invested, it's hard-earned money. I put in my money. These shares have grown. Now I'm going to gift it. I'm already 85, 90. I'm 1 foot toward the grave. I want to. There are so many questions that come up as far as the gifting is concerned. Gifting, in simple terms, gifting is permitted within quotes, subject to Reserve Bank's approval. Very simple. Gifting can be done with a prior approval. Two things. One, or rather three things. You can gift that donee, the donor and donee will have to be related people. They'll have to be related as per the Companies Act. I think clause 77 of section 2 talks about the relatives. I think from what was 22 in the 1950s Act, I think it is 11 or 12 under the 2013 Act. So it is restricted to those set of relatives only. Two, the quantum of gift cannot exceed 5% of the paid up capital of the company, or rupees 50,000 US dollars. Sorry, rupees, it's not rupees, it is 50,000 US dollars. Even if it is 1%, even if it is $5,000, all these things can happen only with the prior permission of Reserve Bank of India. And over and above this, the sectoral cap of the Indian company should not be breached. You'll have to be well within the sectoral cap. You'll have to, the donor and donee will have to be relatives. The total gift of shares cannot exceed 5% of the paid up capital. And in terms of value, it cannot exceed rupee equivalent to US dollars 50,000. Right? So these are the conditions as far as the gifting is concerned. But in all these cases, with all the supporting documents, an application will have to be made to Reserve Bank of India at the central office, who will consider this depending upon the bank. See here, my experience is the reasoning by which you want to gift it is very, very important. How you present the case is very important. The documentary evidence you give. If the donor is already 85, 90 years and he wants to gift it to his NRI son, the way you present it matters. Right? And it has to be, and without the approval, it cannot happen. Right? Sometimes what happens is, if they are not able to gift for some reason, I mean, the age-old father is not able to gift because of they don't get permission from Reserve Bank of India or whatever. Maybe over a period of time in the future, this would land up in a transmission. Hope you all understand this. So transmission is an act of law. Automatically it will get transmitted. I don't think there is any problem there. But as long as gifting is concerned, you need to have permission, even if these are. Why these limits are given? Beyond these limits, you are not permitted. You need not even approach RBI. They will not give you permission. If you are well within this limit, say this 5% limit and 50,000 US dollars, you can do it subject to approval of Reserve Bank of India. This can be done. I think we have covered this. Rights issue. This is another area where people are not. I would say mostly corporates are not very comfortable, especially when they have foreign direct investment and all those things. Straight away, I put it in a nutshell the points. The rights issue will have to be in compliance with the Companies Act. The Companies Act regulations, whatever law applicable, it has to be complied with. That's a question number one. This is the reason they said FEMA is an act which is over and above the applicable act. So you will have to comply with the Companies Act. You will have to go with the rights issue and comply with all the Companies Act requirements, and then only FEMA will come into play. Such issue shall not result in breach of sectoral cap. By making a rights issue, the sectoral cap of 74% or 80 or 24% should not be breached. We'll have to ensure that the foreign direct investment is within the sectoral cap and that does not breach the sectoral cap. The shareholding on the basis of which rights issue or bonus issue has been made must have been acquired and held as per the provisions of these rules. That means the original allotment based on which the rights is being issued should have been acquired based on must have been acquired and held as per the provisions of these rules. That means the original shares for which you are issuing rights now should have been in compliance with the FEMA regulation. Right? A person was resident in India when he invested shares. Now he has gone abroad. His residential status has changed. But the rights issue cannot change his residential status. It will be repat, non-repat only. When I acquired these shares when I was a resident, I acquired these shares on a non-repatriable basis. Now I have changed my domicility. I have changed from Chennai or from Mangalore to Hyderabad or to USA. I am there in US. I have become a US citizen. But the shares continue to be a non-repat. Right shares will also continue to be non-repat only. In case of a listed Indian company, the rights issued to a person resident outside India shall be at a price determined by the company. So rights issue prices can be determined by the company there. In case of unlisted company, the rights issued to a person resident outside India shall not be at, this is the catch. You cannot issue a shares at a higher price to resident individuals and at a lower price to non-resident. Right? This is one challenge we have. That means they shall not be at a price lesser than the price offered to present resident India. Is advantage India. Indian resident will have an advantage. You cannot issue it to a resident at higher price and a foreigner at a lower price. That is not possible. Similarly, the other challenge, practical issue that people have is there are 4 or 5 different people, shareholders, rights issues being offered. 2 of them are non-resident. They are holding the shares on a repatriable basis. The question normally people ask is, sir, whether all these 3 people to whom the shares are issued, can they renounce their rights in favor of the foreign national? That means, can the entire rights issue be subscribed only by the foreign national and not by the resident? This is possible, provided we comply with the pricing guidelines. That is the reason it said that the shareholding on the basis of which rights issue or the bonus issue has been made must have been acquired and held as per the provisions of these rules. This example, out of 5 people, 2 were foreigners and 3 were Indian. These people, the Indians, have acquired the share not in compliance with FEMA. They have just complied with the Companies Act. So these Indian people are holding the shares only on a non-repatriable basis. Right? So what happens is these people cannot transfer the shares or cannot renounce the rights, their rights in favor of the foreign national. This is not possible. This is possible provided the company complies with the pricing guidelines and sectoral cap. That means even in case of rights issue, you will have to, even in case of a rights issue, the pricing guidelines, the valuation will have to be valuation by a registered valuer will have to be complied with. So the challenge here is you will have to plan your rights issue. Even before you make an offer for rights issue, you must know who are the people who will subscribe, who are the people who are not subscribed. Because after announcing the rights, after sending the offer document, if 2 of the Indian residents renounce their shares in favor of the foreign national, at that point of time, you can't go get a valuation and then go for allot them shares at a higher price. Because as per the Companies Act, you have already made an offer. The price has already been determined. Now you can't go back and increase the price. So this could be a dicey situation where unless you know if the rights is going to be subscribed by everybody, or is it going to be subscribed only by foreign nationals, you'll have to structure it accordingly so that the Indian resident can renounce it in favor of the foreign nationals, and the such price is as per the pricing guidelines, and then we can do it. Hope I'm clear here. In many cases, we have this. There are a lot of confusion about the rights issue. Who can subscribe? Who cannot subscribe? At what price to be issued? What is the ratio to be allotted? Whether they can renounce it? Whether foreign national can renounce it in favor of the Indian, or whether Indian resident can renounce it in favor of the foreign national. All these confusions are existing. But the thumb rule is one: the Indian cannot receive shares at a price lower than the foreign national. The allottees or the offerees will have to be holding the shares as and comply with the provisions of these guidelines. 2 issues, right? I think the rights issue we have covered. We'll go to the next. LLP. Sir, it's already 11:54. Can I continue?
Yes, sir. We have time up to 12:30.
Okay, good. I think I have few more slides to cover, sir.
Yes.
I'll just quickly cover them.
Sure, sir. Sure.
The greatest advantage in LLP is there is no FDI linked performance condition. Any investment in LLP is called foreign investment. It's not called a foreign direct investment, it's a foreign investment. A person resident outside India, other than the citizen of Pakistan or Bangladesh, or an entity incorporated outside India, not being FPI or FECI, foreign portfolio investors and foreign venture capitalists cannot invest in LLP. So, non-resident, a person resident outside India, they should not be citizens of Pakistan or Bangladesh, or companies incorporated in Pakistan or Bangladesh can invest in LLP, provided those investors are not FPIs or FECIs, may contribute to the capital of the LLP. The word cap contribution to the capital of LLP is being used, and operating in sectors or activities where foreign investment of 100% is allowed. Straight 100% is allowed. Automatic route alone, if LLP can operate. If there are some conditionalities attached to it, FDI linked performance. If there are, say for example, I'll tell you what the FDI linked performance is. Say for example, if you take horticulture, it has to be only in a conditioned, controlled condition. The growth will have to be done in a controlled condition, right? There are a lot of conditions attached to it in any sector. One thing I can off the cuff I'm able to tell you is, in case of horticulture, FDI is allowed in companies where the growth happens or the cultivation happens in a controlled atmosphere, right? Maybe it is exposed to sun for a little while in the day, and then it is covered, then it is air conditioned, something like that, some conditionalities. So such cases where horticulture is being performed like that, in such cases FDI up to 100% is allowed. So those, something like that, there are some conditions will have to be complied with to have foreign direct investment. In case of LLP, you cannot have any condition linked performance. Everything has to be under automatic route. Everything has to be 100% permitted. Sir, where do I go search? You go to Schedule 1. Find out what are the sectors where 100% FDI is allowed. Right? Sir, many times people call me and ask me, sir, the industry, sir, automotive industry is not given in that list. Sir, I've gone to the Schedule 1. They have not spoken about automotive industry. They are not given anything about sectoral cap on the, what is it called? Software industry, all those things. If you look at Schedule 1, it says the following industries with sectoral caps are permitted with sectoral caps and conditionalities. Sectors which are not enumerated below or given below are, if they don't find a place in that list, that means a 100% automatic route is allowed. They have given some 10, 20 to 25 sectors where FDI is allowed subject to certain conditions. If any particular industry does not find a place in that list, that means it is coming under the automatic route. That is how you cannot find automotive industry, software industry, all those things will not find a place in Schedule 1 because it is under 100% automatic route. In such cases, LLP investments can happen. So when the profit share, the share of profit is brought back to India, it is termed as reinvestment. So LLP Act will have to be complied with. You will have to have an LLP agreement. You will have to incorporate the LLP as per the LLP Act, and then foreign direct investment can come in. Foreign investment can come in, and when the profits are being brought back, then it is categorized reinvestment of the earnings. Investment in LLP is subject to compliance of the conditions of LLP, Limited Liability Partnership Act 2008. You will have to comply with this, incorporate the LLP, and then have the foreign investment there in the LLP. Conversion. This is something very, very, very interesting. The Companies Act 2013 permits a company to be converted into LLP and LLP to be converted into a company. Both are possible, right? So if a company has got foreign investment, and is engaged in sectors where foreign investment up to 100% is permitted under automatic route, and there are no FDI linked performance, only if the company is engaged in sectors where FDI linked performance is not there, only such companies can get converted to LLP. Because LLP is allowed only in sectors where 100% FDI is allowed without any FDI linked performance. If the company that is to be converted into LLP is already engaged in a sector, say for example, horticulture. There's a private company into horticulture. Now horticulture has got FDI linked performance that cannot get converted to LLP. This is not possible. Similarly, LLP can get converted into a private limited company. LLP having foreign investment, engage in sectors of foreign investment up to 100% is permitted under the automatic route, and there are no FDI linked performance conditions. Similarly, if or naturally LLP cannot have FDI linked performance, and such LLP can be converted into a company. But the question arose, one classic case that arose was that, see, LLP is not eligible for external commercial borrowing because it is not, there is no instrument being issued, there is no security being issued, it is only investment in the capital. So LLP by and large is not involved, is not eligible for an external commercial borrowing. But a company is eligible because equity investment is being given. Equity shares is being given. So a company is eligible for ECB. So a company wanted, having ECB, wanted to convert it into LLP. In one case, Reserve Bank of India permitted it because the company had borrowed that money long back. It has already had 4, 5 or 7 years of ECB, and now they got converted into LLP, but they continue to comply with ECB regulations, though ECB was not permitted in LLP. So when you convert, you can't form a company, take ECB, and then immediately convert it. No, that is not possible. The authorities will open their eyes, lift their eyebrows, and see what is this. That is not possible. You have already borrowed money, you are already substantial time has passed by, your repayments are regular. Now, for some reason, you want to convert that company into LLP, then that is possible. Or in case of LLP, you can convert them into private company and then go for an external commercial one. Such cases, you will not have a problem. Okay. Last. So with this LLP conversion, I think the session concludes. I think by and large, whatever possible in this one and a half hour session, I've covered everything. Mostly, I've covered only those specific areas which has got complications, which in my opinion, I get calls, I get people ask me for clarification. Only those areas I've covered, especially in limited liability, conversion, on the basics I've covered certain things. I think with this, you can go into the non-debt rules, understand the entire rule, the chapters, the schedules. I think foreign direct investment will be very, very easy thing for you guys. Right? Last, thank you, gentlemen. Thank you for this opportunity. And as I said earlier, please do join the Telegram group. All your queries will get answered. Anything you can ping me from your Telegram group, Telegram account to me. I will include you in that thing. Right? Sir, I'm ready to take questions. Sir. Yes, I'm ready to take questions. Any questions? Probably the moderator can coordinate and I can prepare to take the questions.
The first question. Sir, the first question is, how do we determine the location of the asset when it comes to decentralized assets like cryptocurrency? Where is it? It is regarding capital account transaction. How do I know an asset is in India or outside when it comes to intangibles?
See, basically, intangible goes along with the intangible alone. I don't think it is being goodwill alone. I don't think you can sell it goodwill alone, right? It has to come along with the container, along with the company, and along with this. I don't think goodwill alone can be sold like that. To my experience,
sir, that Kingfisher brand, they have mortgaged to SBI, no? Only that brand can be sold, no?
No, brand alone can be sold, sir. Brand alone was sold to, see, the brand alone was actually, it was mortgage. I know of an ice cream company in South which has pledged its brand alone, right? That is only for the purpose of taking loan. It was not a cross-border transaction. When the borrower refuses to repay that loan, the lender cannot do anything with that ice cream brand. In fact, that was the question I asked. When they mortgaged that ice cream brand and took some 25 crores or 30 crores on that, nothing I said, what happens if you don't repay? Nothing can happen. Because the lender is a bank. With 25, 30 crores, what will they do? What will they do with the brand? So the sale of brand is possible, but I don't think it could be a cross-border, and it has to be looked into, sir. Maybe, as you say, in case assuming that it is possible, it is brand is alone sold to outside India, or you buy a brand from the cross-border, then it becomes obviously it becomes a capital account transaction, because the brand obviously is a capital account. It is a part of the balance sheet. So you'll have to look at the capital account transaction norms and do it. It's a very interesting question that I've never thought of this. Very interesting question.
Okay, so next
Good
one
question
is
is
the
nine.
two
Yeah.
directors of private limited company in India incorporate an LLC in US to facilitate collection of debts due for software exports from India. The investment is small, say 5,000 USD. Is reporting required?
See, basically, what are the transaction is they are buying out the debt, right? That means they are doing the
Facilitating collection of debt dues.
Yes, collection of
Correct.
debt. What happens is here the software the customers owe money to the software company in India. So those people pay on behalf of the software company, and collect the debt later there. This has to be reported, because when I make the payment, say for example, the company is incorporated as LLC in America. As far as the software entity is concerned, or the supplier is concerned, they should have received the money. If they should have received the money either from the new LLC that is formed or from their end customer, either way they should have received the money. So such receipt of money is a current account transaction that passes through the AD bank. So reporting becomes automatic. When the money comes in, it gets reported automatically, right? And there, the collection that happens to that LLC is need not be reported, because that is their business there. It is not being repatriated. Hope I am clear here. Money is received for and behalf of the supplier. When the money is received for and behalf by the supplier in India, reporting becomes automatic, because money comes only through the normal banking channel, right? It is automatically gets recorded in the EDPMS, export process documentation. It gets recorded. Money comes from abroad. It has to come from abroad only. This LLC cannot pay the money in India and say that they have settled the dues and they'll collect it abroad. No, that's called hawala. So the LLC formed in US will definitely have to pay either from their sums or collect the money and pay it in India. It has to come through normal banking channels. That means reporting has become automatic. It gets recorded in the EDPMS. The monies they collect is their business. It will be parked there. So that reporting may not happen. Next, sir.
Capital instruments, does it include debentures?
Yes, sir. Both convertible, non-convertible debentures are mandatory. Reporting is required. In case of convertible debentures, it becomes equity. It is treated as equity shares. Filing of FCGPR is mandatory. In case of non-convertible debentures, it is treated as external commercial borrowing, and ECB guidelines will have to be followed.
Private limited company in India engaged in export of software services has not registered under STPI. Transactions are done through AD banker. The company wants to write off bad debts due from abroad. What's the formality, as the company does not file soft tax?
Sir, there are two questions, two parts to it. Writing off and registering with the soft tax. There are two things, STPI. So as far as the write-off is concerned, I think the maximum cap without the RBI approval is only 10% of the average of the last 3 years turnover, if I remember right. And soft tax registration is separate part that has to be handled. So write-off can happen up to 10%, and beyond that, will have to approach RBI and then get it written off. For which they'll direct you to go back to STPI and have it registered. This is how it is. Next.
This is pertaining to FCRA and not FEMA. As per Rule 6 of FCRA rules, a person receiving foreign currency from relatives abroad above rupees 1 lakh has to intimate to central government under Form FC. Could you please clarify?
From whom has it been received? For what purpose it has been received? That is very important. Because if it's a Foreign Contributor Regulation Act, unless you have FCRA registration, you can't receive. But on a case-to-case basis, you can make an apply. I think prior permission is required for one-time transaction, depending upon the circumstances. I'm not very sure about it, but I've heard of people talking about prior approval for one-time transaction. Because to get an FCRA permission, I think it has to have some 3 years of track record and all those. It's a very big process. So one-off transactions can happen.
Okay.
Next, sir.
Can a foreign corporate gift shares in its Indian subsidiary to its Indian directors for nil price?
Sir, the moment you give it as a nil price, see, we'll look at it from 2-3 angles. That means it's a transfer of shares from abroad to its directors in India, right? Am I right?
Sorry, sir. Sorry.
If I understand the question properly, it is a transfer of shares by way of gift, that is without any consideration.
Correct.
From a company abroad to its directors in India.
India,
right?
correct.
That
correct.
means had they sold it for some consideration, right? They would have done a valuation, got the valuation done, and they would have sold it bought it at a price far lesser than the valuation price. But here it is a gift. Yes, one, it can be done only through relatives. So gifting is not possible because the company and the directors are not related. So gifting is not possible. And when you file it, when you sell it at a zero consideration, you may have challenges in filing FCTRS, because when you file FCTRS, it will ask for the form A2, and it will also ask for the price which is being paid and the valuation report. You can give the valuation report, but FCTRS will not accept the figure 0 there. The consideration cannot be 0. So you will have practical. First question is, gifting of shares from company abroad to directors in India is not possible because they are not related. 2, even if it's going to be treated as a transfer for zero consideration, you will have difficulties in filing FCTRS. Next, sir.
Next, shares in an unlisted Indian company are being sold by an NRI to a foreign company for nil consideration. The same is being done as a part of global transaction. FMV will be arrived at base, and gain will be declared by the individual as per section 50C of ICAI. Will there be any FEMA implication based on the valuation rules?
Sir, we need to understand how the NRI has been holding the shares, whether he was holding it on a repatriable or non-repatriable basis. If he is going to hold the shares on a repatriable basis, then he is selling the shares to a foreign company abroad. He will not require any reporting because it is not a cross-border transaction at all. As a good governance, it's better that we report this to the Reserve Bank of India on a plain paper, right? The letterhead of the company giving the details of the transaction and the pre and post shareholding pattern of the transfer need to be given if the shares are being held on a repatriable basis. Now, if the shares are not being held on it is held on a non-repatriable basis, and if you are going to transfer the shares to a corporate entity abroad and who wants to hold it on a repatriable, obviously I presume that a corporate entity will want to hold the shares only on a repatriable basis and not on a repatriable basis. Non-repatriable basis. So when there is a transfer of shares by non-resident to an overseas to a foreign company on non-repatriable basis, you will not have a problem. If it is repatriable to non-repatriable, you may have complication. You need to have the approval. Hope I am clear in this question.
US-based company gets its software supplies from a private limited company owned by Indian shareholders in India. The US company offers a sweat equity to some of the directors of this Indian software company. Any compliance issues?
Sir, basically talking about ESOPs, you will have to later on these ESOPs offered will become ODI in the hands of those investors in India, the Indian directors, right? So it could be at a price far lesser than the price that is valued price abroad. So it is better that we need to inform RBI about this in a plain white paper about the ESOP that is being granted, because as of now it is only grants that is being given, and exercise of these options are going to take place later.
Okay. Whether permission from RBI or Government of India is required on selling immovable property in India by foreign national of Indian origin to an Indian citizen, keeping in mind the recent Supreme Court decision Asha John versus Vikram Malhotra under FERA.
Yeah, sir, this question I need to do some homework and come back. Maybe the selling of immovable property, given the background. I think the queries may please write to me. Probably I'll do some thing and come back. Of that, because it requires a lot of explanation also. I'll probably come back later.
Okay. Can a public charitable trust borrow from NRI? If so, what are the conditions?
Public charitable trust borrowing from NRI. First, see whether the charter permits them to borrow money, right? So whether we'll have to examine whether it will come under external commercial borrowing. I think trust is permitted to borrow money from abroad. It will come under ECB, so they can borrow. But if it is an NRI, from where he is going to give, whether he is going to give it from an NRE account or an NRO account matters. If it is NRE, then it becomes an external commercial borrowing. Reporting is required here.
Okay. And one more question regarding the sale of immovable property. Sir, an SSC who is a person of Indian origin presently residing in US owns an immovable property in India. Can he transfer to NGO here in India? And what if he becomes a trustee of this trust and thereafter transfer? What are the implications under FEMA? Or
Sir, basically you should understand how this property was acquired by him. Why is it a self-earned property, or whether it's an ancestral property, whether it's an inherited property? So all these things will have to be looked into before we answer, sir. I think this transfer is possible as long as it is an inherited property, as long as the monies are not repatriated out of India. See, basically, RBI is bothered only when, be it an immovable property or be it a transfer of shares, sale of shares, purchase of shares, securities. The complication comes only when I want to take the money out of India. As long as I don't want to take the money out of India, by and large, the compliance requirements are very simple. As I told you earlier, as long as I receive gift, I don't have to bother about anything, because it's not going to go out of my kitty.
Correct.
As long as the moment I say I go to return, I need to return it. At the moment I say it is going to be a loan, definitely all sorts of complications will come in. I need to understand about the reporting. I need to understand about the tenure. I need to understand about the interest, everything. So similarly, whether under what form it is going to come, whether repatriable or not repatriable is a question. Yes, sir. Next.
Sir, I have one question.
Yeah.
One of my clients is a company. They
Yeah.
have been regularly importing some goods from a client from abroad over more than 10 years, for the last more than 10 years.
Okay.
Substantial transactions were there on credit basis purchases.
Okay.
Now the Indian company made heavy losses. They are unable to pay.
Okay.
So more than 1 year that outstanding is there. What to do?
Approach your AD bank. Approach your AD bank. Tell them, because all these imports are recorded in your IDPMS. So approach your AD bank. Tell them that because of the financial position, you are not able to pay within the scheduled date. Right? So before the expiry of the scheduled date, go and approach them and take an extension of time. Maybe they'll give you extension of time once or twice. And third time, when you approach, probably ask your supplier also to give a letter saying that they are not in a hurry to claim. They are not claiming it immediately. And supported by a chartered accountant certificate about the repayment and the financial position of the company. I think by and large they will allow you. They'll give you time. You can't write it off.
But
a liability is a liability.
But if they are unable to pay, then what to do because of losses?
Sir, what to do? It is the hands of the overseas supplier. So overseas supplier will have to see because it is an asset for him. He has extended, he has transferred goods.
Hmm.
So there specifically you need to approach RBI through the AD bank.
If he writes off, if the person from there, if he writes off.
Correct, sir. Then we need to approach the RBI through the AD bank and ask for the permission to write off the entire thing.
Okay.
Any other
Thank you.
questions, sir?
What if an NRI donates to a charitable trust? Any compliance requirement?
From where he is going to donate? Is it from abroad, or is it going to be from his NRO account here? That's the matter. It's a foreign currency for the donee. For the donee, it becomes a cross border. So then they will have to approach RBI and take Home Ministry take specific approval because the trust or charitable institution is receiving money from abroad. If it is from a rupee account, then I don't think it's a problem. It's a normal any other donation for that matter.
Okay, with this, we come to the end of the question, sir. If
Yeah.
at all there is anything left, I request the participants to quickly answer. We have the next session speaker, Parin sir, who has already joined us. So we can spare another 2-3 minutes. If at all anybody has any question, you are free to come online and ask directly.
Sir, I suggest that they can write to me, sir. I have shared my
Sure, sir.
email ID. I have shared my mobile number. So I'm only, I know they can, I'm available on a click, walk and talk. Though walk
Yes,
is
sir.
not possible now, they can't walk into my office. So they can click me and write a mail to me, or they can pick up their phone and talk to me. I'm just a
Sure,
click,
sir,
walk
sure.
and talk away for any of the participants here.
Yes, sir.
Anything
Chairman
else,
sir,
sir?
anything that you would, Chairman sir, anything that you would want to add as your concluding remarks for the first session?
No, so whether sir can now our next session is there.
Yeah.
Sir, whether next session will be on the cryptocurrency. So whether you will be available, sir, you will be available till end because any.
You'll have to excuse me, sir. I have other commitments, sir. I have some
Okay,
professional
okay.
commitments. So you'll have to excuse me. I think I specifically request the next speaker, Mr. Parin Lalit, to excuse me on this. I'm not able to participate. I'm able to see him on the screen. I'm extremely sorry. I have other commitments. But
Yeah.
anyway, sir, thank you for the. I thank the organizers, the participants, everybody. Thank you so much for this wonderful listening. I hope I had delivered the best. I hope you are able to understand whatever was discussed in this one and a half hour session.
Yeah, yes,
Thank
sir,
you
it
so
was
much.
wonderful.
One small request: please put on your mask. Please sanitize regularly. Please maintain social distance. Please stay safe. Thank you so much. Thank you.
Thank you, sir. Thank you, Sridhar sir. The fond memories that you have of Mangalore and your visit to Udupi. Probably next time, maybe once everything settles down, we'll invite you to the branch and once again display our hospitality and the great culture and history of heritage of Mangalore and Dakshin Kannada. Hoping to see you
Definitely.
soon sometime here in Mangalore, and we thank you once again for a wonderful and lucid presentation. Very simple and yet the purpose with which it was kept, it has served the purpose, and on behalf of all the participants, we heartily thank you, sir. Thank you very much.
Yes.
Thank you, sir. Thank you, everybody. Thanks for every participant. Thank you so much. Thank you.
Okay.
Thank you.
Chairman sir, we have the next session speaker, Parin sir, who has joined us.
Yeah, please will let you can briefly again you can introduce the speaker, then let him take over the session.
Respected chairman, past chairman, members of the committee, and all the participants, and especially the resource person for the second session of the day. Once again, warm welcome and very good afternoon. The second session is on crypto talks, the introduction and the future of cryptocurrency. And we have an expert in this field, Mr. Parin Latia sir, to tell more about him, to introduce him to the audience. He's an entrepreneur, minimalist, yoga. He's into yoga, bitcoins, and economics. He has built a tech service company and serviced some of top Indian companies for the past 6 years. He has built a software as a service product that is still generating revenue without a single employee. Relocated to Goa and built Happy Panda Hostel and took it to top-rated award-winning hostel within 8 months. Sold it to Zostel EDP participants who chose to retain the name and not partner with it later on. Built Imagination Artist Hotel as a non-profit initiative in the next year and again beat all the hostels, including Happy Panda. It is now ranked the best hostel in Goa. Been a crypto trader and a blockchain enthusiast for over a year now. Traded a portfolio to 20x. Ghostwriting a lot of articles on cryptocurrency on Upwork. He's a crypto analyst and writer for various publications and clients. Sir, on behalf of the branch and all the participants, I heartily welcome you. There is a lot for us to learn with regard to cryptocurrency. It is the theme itself is foreign to most of us, so we are in for a good, enriching and enlightening session for the next 1 hour. Over to you, sir.
Thank you, Mr. Chairman. Thank you, Mr. Gautam. Thank you for inviting me here. It is a privilege to talk to this audience, and I hope to share the fundamental idea behind cryptocurrencies, introduce what cryptocurrencies are to everyone, and then delve a little bit into regulation and taxation part, and then happy to answer any questions that the audience might have. Thank you. So we'll start.
Yes, sir. Just yes, sir. Just a minute.
Yeah.
Yes. Okay, sir. We'll start, and I request you to be a little bit louder, sir, so that.
Sure.
Yeah.
Okay. So thank you for being here, everyone. Today we are going to look at what cryptocurrencies are in the first place, try to understand them, and then look at how regulation will play a role and how they are being taxed right now and how they might be taxed in the future, right? So today cryptocurrency and Bitcoin have become a buzzword, but usually that happens only when the price is going up. Usually we have a 3-year bear market and 1-year bull market. So only in the bull market, people realize that cryptocurrencies hold some value. The reason people do not understand this is they do not understand the foundations of why cryptocurrencies exist in the first place. To understand anything, let's go to the genesis of why cryptocurrencies were started. And just as a general warning, it's very, very difficult to understand cryptocurrencies. Usually, we say that cryptocurrencies come at an intersection of all of these subjects. So you can look at, let's say, Bitcoin from an economic perspective, from a political perspective, from a monetary policy perspective, from IT perspective. And unless you understand it holistically, it'll just seem like something that does not have enough value. So today, what we are going to do is I'll run you through the foundation first of why cryptocurrencies even exist. And to understand that, first we have to go back in the history and look at what really money is. Because today we've narrowly defined money as INR or USD. The generation that is coming up today, millennials are not even considering something like gold as money. It's too boring for them, right? So let's look at that very quickly, and then I'll explain what Bitcoin is, what blockchain is, and some kinds of cryptocurrencies, right? So today, what we are going to do is look at it only from an economic perspective. That's what we are here to do. Of course, I would really urge everyone to go and check out other aspects of cryptocurrencies as well. But let's dive deep into what is money first. So today, there it's been very, very narrowly defined that the paper that we hold in our hand or the balance that we see in our bank accounts is money. But what exactly is money? Is it paper? Is it something that's just called legal tender? Is gold money? Is, let's say, a painting that I hold money? Is money something that I just pay and use as a medium of exchange? Broadly defining, money is essentially just purchasing power. The numbers do not matter, whether it is $1 or 70 rupees or any amount that is denominated. Essentially, money is its purchasing power, right? That's the value. Just to understand from a historical perspective, our ancestors, right through last 30,000 years of history, have experimented with this concept. So all civilizations have had some form of trade, and when you have some form of trade, you have some form of money that is being used, right? So we've already experimented, and there is documented history about what money is. Uh, Let us look at it from this first principle perspective. Fundamentally, what we've done, our ancestors rather, have experimented with various objects and used them as money. Either in one civilization or the other, we've seen these experiments go on. But we do not use any of this right now. We do not even use gold as money right now, although it is very valuable. Why? Why is this true? And why do we have this paper money, right? It is because these objects do not have these properties. So with these experiments, we've derived the properties that an object needs to become money, right? Of course, barley will spoil someday. If we use pebbles as money, I could just polish a few more stones, and there'll virtually be an unlimited supply of this money, and it can't happen like that. Right? So, if I use cows, let's say, as money, I can't divide and pay you. Copper plates were used as money in ancient Venice. Uh, Banking started with copper plates, but they were really large and heavy to carry around. So there's no portability. And with gold, we have problems when it comes to measuring how pure it is and transferring it to people. It's heavy to transfer, right? So these are the problems. Now, as technical terms, I'm sure a lot of you must have heard, this is what uh, we know, that anything that has to become money has to become a store of value, unit of accounting, and medium of exchange, right? Now we know, and we've done all of these experiments. Uh, just most interesting history of money has been in the last 150 years. 150 years ago, uh, we had something called a classical gold standard, right? So every king or every democracy issued its own currency, but how do you measure the exchange rate for international trade? And there was only one object that had these properties to be used in international trade, and that was gold. So what we had at that point in time was lot of sovereign money, but backed by gold. This was called the classical gold standard. Now, looking at this just last 150 years of history, we've moved from classical gold standard, which meant if, let's say, my king or my democracy is issuing me money, I could actually go to a bank with that note or with that promissory note, and I could get gold in return of that. That there was an era when this actually happened. So absolutely every rupee or dollar, whatever the currency was that was issued, was backed by gold, 1:1. Then came the gold standard when it happened to be a fractional reserve system, and the government said, okay, it's too risky for all branches to hold gold. Let just the government hold gold, and we will issue X number of paper notes against the amount of gold that we are holding. But this all changed, and in 1971, US and most of the democratic world moved to something called fiat system. Uh, I conduct these classes for a lot of fund managers and some MBA students. There are a lot of people in the audience who think that our money today, the fiat rupee or dollar that we are holding, is still backed by gold. Uh, that's not true. It is absolutely not backed by anything. Today, what we have is USD standard. And if you just look at Investopedia definition of fiat money, the definition itself means it is not backed by anything. Right? So, how did we go through this transition, and what were the effects of this transition? Right now, we've looked at history of money very uh, clearly. We went from 30,000 years of history and derived that gold is probably the best object to determine someone's purchasing power. But in 1971, when we went to fiat standard, you will see the gold price, what happened to it, right? You will see these wild swings. You will see that it seems gold price is perpetually going up. Now, this you will see with a lot of assets. A lot of assets, if you look chart, let's say Nifty, S&P, any index, most commodities, on a 100-year diagram, you will see something like this. This is called asset price inflation. That's happening today. And every market is essentially at its top, right? Why is this happening? And since when this is happening, we can see it very clearly. This is happening because of this. So if you go to RBI website, download M3 money supply data for last 20 years, 30 years, you will see this kind of a graph. This is M3 money supply. And there are a lot of technical terms to these. They call it quantitative easing, liquidity injection, issuing of bonds, lot of ways. But essentially, what this means is there is more liquidity in the economy. All the stimulus packages that US, India, most countries have been issuing, the government, RBI doesn't have that much money. What they are doing is they are sort of, in very, very loose terms, they are printing money and injecting that liquidity in the economy. Now, this will trigger an inflationary cycle, but it doesn't affect immediately. It takes a few years for this liquidity to sort of trickle down. And then when it comes in the hands of common people, prices just shoot up. Some countries, everyone I think knows, like Venezuela, has gone into hyperinflation. Even if we don't consider an extreme scenario like that, at least the inflationary cycle, what it does is on an individual level, it bleeds our purchasing power, right? So today, if I am holding a significant amount of my wealth in, let's say, FDs, I get maybe 7-8% return, but government has been printing money at almost 25% per year in last 5 years. So the money supply in the entire economy is increasing by 25%, whereas my savings are increasing at the rate of 7-8%. 30 years later, when I retire and I want to buy that dream house I won't be able to buy, right? Because the purchasing power is being lost by additional liquidity in the market. This is the reason whenever there is severe liquidity injection, usually people used to go and buy gold because that's the only form of hard money that we know that's reliable, apart from land maybe, is sort of semi-hard money. Uh, where the supply cannot be increased drastically tomorrow. But when it comes to fiat, the supply can be increased drastically tomorrow. And we've seen this. There's an interesting study. US doesn't print its M3 supply on its website. Federal Reserve doesn't do that anymore. But a lot of people have analyzed the money supply in the US, and there are estimates that 20% of all money circulating in US economy today was injected in just 2020 during the pandemic. That's massive. That's trillions of dollars uh, injected in 1 year in the economy. Now, in a few years, there might as well be a high inflation cycle that will kick in, right? So this is the core problem with fiat money. And we've seen throughout history, whenever fiat money goes out of control, uh, it leads to fall of civilizations. But it also leads to one very deep-rooted, important problem that we often overlook. So this is what has happened in the US. since 1971 to I think 2019, this data, 2018, right? What has happened is top 5 to 10 percentile in terms of wealth, the population, their income just kept on increasing, whereas the middle class and the lower class, their income uh, was mostly flat in this span since 1971 to now. Now, most people would think, okay, the rich people are smarter, so they have better investments, so of course they make more money. And middle class and poor people usually take poor decisions and they end up not investing their money. But the reason behind this is not poor or good investment decisions. The reason behind this is the way this newly created liquidity is distributed in the economy. What happens here is when new money is created, usually it's created at RBI, then it's distributed to banks. Banks loan this money out to businesses, and then businesses employ people, give them salaries, and give dividends to their shareholders. That's how this trickle down economics has to work. On paper, that is how it works. But we know that's not how it works, right? The people who get that money at the top, they end up absorbing a large part of this. That's what creates this large income and wealth divide that we see today, that we see billionaires in places like Mumbai, and we also see uh, slum dwellers living right beside them. This has happened in history in various civilizations whenever they try debasement or inflation with money. Essentially, this leads to large income and wealth inequality. Uh, Keeping in mind these problems, one person or a group of people, we don't know who they are, uh, invented something called Bitcoin in 2009. The aim was to create a peer-to-peer form of hard money. Hard money means that Bitcoin's supply will only be limited to 21 million. There will never be more than 21 million Bitcoin in existence. It's protected by cryptography. If any of you is interested in math or cryptography, you should look at Byzantine generals problem. There is a famous mathematical problem that was never solved, and Satoshi Nakamoto, the inventor of Bitcoin, solved this while creating Bitcoin, and that's a big leap in cryptography that has made this invention possible. Right? Bitcoin is completely global. There are no restrictions. There is no company called Bitcoin. There is no CEO of Bitcoin. There is no jurisdiction for Bitcoin. uh, Transactions on Bitcoin's network are immutable, which means once I send you my Bitcoin, that transaction cannot be reversed. Like our bank transactions, they cannot be reversed. And of course, it is decentralized. So what this means is there are millions of miners and node holders across the world who run this network that allows us to transfer this value, uh, very similar to we've seen how we transfer files through torrents, right? It's just a local network of computers, and everyone has this file, and keep sending you bits and bytes, and then your computer compiles that, and it becomes an entire, let's say, movie or book or whatever we were transferring. So this Bitcoin, what it has done is it has made possible a peer-to-peer transaction. So the simplest way to understand Bitcoin uh, is to look at how transactions go through. So today, let's say if I want to give you 500 rupees, I log into my GPay, I put in your UPI ID, I send it to you. Uh, it goes to your bank, and then it goes to your GPay, and that's how you can see the balances reflecting now, right? In this entire transaction, there are at least two middlemen. One is Google and one is our bank, assuming we use the same bank. At least two intermediaries. Ideally, what happens is these people maintain a ledger, and that's all there is. When I open my bank balance on my Kotak app or ICICI app, essentially it's not cash in their vaults. Today, most money in most economies is digital money, which means it's just an entry in a ledger in a database on Kotak Bank server, which says, okay, Pareen's balance is this much, right? What Bitcoin does is it makes this ledger decentralized. So now there are millions of node holders, common people like you and me, and there are so many miners who hold this entire ledger. But this ledger is encrypted and it is divided. So although you hold the ledger, and the network can verify details of the ledger from your computer, but you can't see any of the transactions. So it's completely secure, but it is also decentralized. Uh, what happens essentially in a transaction, uh, let's take an example. If I send 1 Bitcoin from my wallet to my friend's wallet, the way this transaction goes is it's broadcast to the entire network. There are a lot of miners who are solving these cryptographic puzzles. These miners, they pick up my transaction and they solve that puzzle and encrypt that transaction, put it in a block. Now, every 10 minutes on Bitcoin's blockchain, there is this block with a list of transactions. This block is connected to the previous block and the next block that is generated. This is how transactions are stored in a chain. So you cannot just remove one transaction and reverse it because the entire blockchain will lose its integrity. And all of these miners, they are sort of providing their processing power to keep this entire blockchain secure. So that's the simplest possible definition of how Bitcoin's blockchain works. Uh, Now, what happens here is there is no middleman, absolutely. And Bitcoin's sort of monetary policy, how much it will be supplied and what kind of Bitcoin will be created, all of that has been written in Bitcoin's code, and this code cannot be changed. So this is an entire open source economy built inside Bitcoin. This makes it very similar to gold. Essentially, the mining part and the supply part has been modeled entirely on gold. Only thing is, gold supply grows linear, Bitcoin supply goes down in a deflationary method. So that's what makes Bitcoin more scarce than gold, and that's why we see its price going parabolic every 3 or 4 years. This happens. So that's the basics of how Bitcoin works. Now, a lot of people realize that there is a lot of value to this technology, the underlying blockchain technology. And what they did was they copied Bitcoin's code and they started building on top of that. So now we have Ethereum that allows people to build decentralized apps on its blockchain. We have gaming blockchains, we have now medical blockchains, we have real estate blockchains. Everyone is implementing this in their own industry. But at the heart of it is decentralization. What all of this means is that today I have to trust someone to use any service like Facebook or my bank or anything. Tomorrow, the future is where we will not trust anyone. Every transaction that happens online will be decentralized and it will be controlled by no one company or uh, party that can sort of manipulate your data, right? So that's the idea behind entire crypto industry. Now I think we are overshooting the time already. I had some myths to be busted, but let me just get you introduced to a very simple way of making sense. Now there are, I think, almost 20,000 popular cryptocurrencies out there. It's very difficult to make sense of all of these things. So first step that anyone looking at cryptocurrencies should do is to categorize it. So there are four most popular types of cryptocurrencies. Now there are more categories coming up, but essentially right now we only see four, which are very popular. First of it is securities. We don't see security cryptocurrencies in India right now because that's completely illegal. But essentially, what large companies like Binance are doing is they are tokenizing equity shares. So what Binance has done, for example, is tokenized Tesla's share as a cryptocurrency and then listed it on their own exchange. This use case will perhaps come in India when regulations are in place. But right now, of course, tokenizing equities is not legal in India, so we don't hear about them a lot. Second type is utilities. This is one of the most popular types. Utility token is any token that is used in a particular ecosystem. So think of it as your Starbucks points or GoIbibo points that you have. These can only be used in a particular ecosystem. Only one company issues it, and one company can redeem it. Right? So that's utility token. Third kind of token is assets, essentially Bitcoin, and every asset that is trying to capitalize on some kind of a scarcity property is just a simple asset. NFTs, a lot of decentralized finance is a part of this. Those have become buzzwords these days. And the fourth type is stablecoins. Stablecoins are any currency that has been uh, sort of backed by a fiat currency. So most popular stablecoin is USDT. Has been issued by a private US company, and what they say is we are issuing this cryptocurrency and holding as much USD, equivalent amount of USD in our treasury. These firms are not yet or subject to audits and stuff. So sort of high risk business, but still people are using stable coins. They are pretty popular now. So those are the kinds of popular cryptocurrencies. I think we should go to taxation instead of busting myths, uh, and then I can take questions. So crypto is often seen as something that is opposite to regulation. That's one of the biggest myths out there. As an industry, we want regulation, and any innovation comes early, and then it's followed by regulation. And we are in that phase where it's an unregulated industry. Uh, we are all pushing towards regulations, and actually, people think that Bitcoin is used for money laundering, cryptos are used for money laundering, uh, but the International Payments Transfer Protocol (SWIFT) conducted a survey and they released a report saying less than 5% of all money laundering is happening in crypto. Most of it is still happening in fiat currencies, and there are well-established routes to do that. So that's one myth. Second myth is a lot of people think cryptos are untraceable, so people don't pay tax and stuff like that. That's so not true. In fact, it's the opposite. A lot of people think that Bitcoin, for example, is anonymous and people can't trace. That's a big myth. Bitcoin is completely traceable and it is pseudonymous, not anonymous. What it means is I give you my wallet ID, but if my wallet ID belongs to a KYC exchange, government can always find out who holds this wallet. And that could be for tax purposes, that could be for compliance purposes, that could be for, monitoring legality of transactions as well. So in fact, uh, cryptocurrencies, when regulated, bring about more transparency. For example, Bitcoin, the entire ledger, right from 2009 till today, every transaction that has happened on Bitcoin is on that ledger and it's public for everyone to see. Now, all government needs to do is cap the source where INR is being converted to crypto, which is exchanges. And if you just implement KYC, AML standards, which already exist everywhere else, on this, with these regulations, in fact, the money that comes inside crypto becomes increasingly tax traceable and reduce corruption in that way. So that's already happening in a lot of countries. Countries like Japan, Singapore have been very forward with regulations, and they are already seeing a lot of their money, a lot of people's money being converted to crypto. But now, because they have KYC, AML laws in place, this becomes completely traceable. So that's the beauty of crypto. Now, biggest use cases that we are seeing right now is one is neobanks, where there are banks that are just on apps. There is no physical presence of the bank at all. Because today we can see that most of the work that a bank does could be done by an algorithm or could be done by a software that's intelligent enough. So a lot of banks are now becoming neobanks. Second biggest use case is decentralized finance. Today, as we discussed with Bitcoin, value transfer online has become peer-to-peer. So now what happens is anything that you want to automate can be done peer-to-peer. So let's say peer-to-peer loans. Today, how do we manage our loans? I go to a bank, I deposit my funds. Let's say I do an FD. Bank gives me certain interest. Then there is a ton of paperwork from my side, ton of paperwork from person who's borrowing that money. And then the bank will charge a little bit of margin and give it to companies or individuals who want to borrow the money. Now, this entire thing with decentralized finance has been converted to P2P. So today there are a lot of lending protocols that are coming in, where you can vouch for your assets. There are credit rating agencies coming up on blockchain, and based on this, these protocols or lending platforms will just issue you a loan in Bitcoin or in USDT or in Ethereum. And when this happens, what we are doing is we are eliminating the entire process that the bank used to do, which was super inefficient, right? So this is the simplest example of decentralized finance. With this, now we will have P2P insurance, we'll have P2P mutual funds. Lot of things will be just software code instead of a bunch of people sitting and figuring out how to do this. And that will also bring transparency, because most of these projects are also open source. So as a customer who is lending or borrowing, I can go and I can check the code, or I can check the white paper. I can check how many audits this code has been through. So these are evolving as of now. And of course, the latest trend is NFTs, which is tokenization of unique assets. So this means my house can be tokenized, my car can be tokenized, and these use cases are just opening up. So that's about the use cases. Taxation right now, there is zero circulars about taxation on crypto. So we just have some industry opinion leaders like Nishit Desai Associates. We have a few other people like ICAI Law, Khaitan and Company, who has a department on crypto, and their experts have gone out and issued guidelines on how crypto investors should manage their taxation. A lot of people think crypto should not be taxed, or is not taxed, or is not traceable. That's absolutely wrong. Government already has tax mechanisms in place to trace all crypto transactions. And as a citizen, if I am making money on crypto, I should be going ahead and paying my taxes, right? The way these experts have categorized all the crypto income and taxation on that is in these four ways. One is, of course, long-term capital gains tax. So let's say if I buy Bitcoin today, I sell it 4 years later for, let's say, 5 times the gain. I'm supposed to pay 20% long-term capital gains based on that gain. Let's say if I'm a trader who's trading daily, weekly, monthly, whatever, that would be treated as business income, straight away taxable at 30%. Then a lot of people now, this is about trading. A lot of people now are taking and giving payments in crypto. So for crypto payments per se, it is business income, uh, ideally payable at the highest slab again. And there are various ways some people make their crypto. So some people don't go on an exchange and buy their crypto. So you just don't have a cost price. to this crypto. So how do you determine what profit has been made? For example, mining, I can go and buy some hardware, I can mine some coins and then sell them and make a decent profit on it. So for mining, staking, airdrops, usually people spend some kind of an expenditure for gaining these rewards. But of course, that's not buying or capital income. So you just take it as business income, reduce expenditures, and pay out. So this is as simple as what people are following. Now people are looking at regulations and how the government treats each income and how GST is levied. Right now, there is zero clarity on how GST is to be managed for all of these things. But that's a risk that people are taking to join the industry and for the upside that they think the industry will give them. I think that sort of concludes what was to be covered from my side. Maybe I can take 5 minutes and just go through all the myths. While everyone can just post your questions in comments, and I will start taking them one by one. Let me bust some myths. I think 5 minutes for that is definitely worth it. Uh, of course, Bitcoin, some people think it's illegal, some people think it's illegal, some people think it's legal, but essentially Bitcoin or crypto is an unregulated market. Every technology comes this way, uh, right from TV to telecom to internet to computers. We've seen regulation takes some time, and we are in that uncertain area. Also, taxation, there are myths that we should not pay, why should we pay, and I should not pay unless I sell my crypto and stuff. That's not true. It's considered like a regular asset, and you have to pay taxes on that. Uh, there is a clear myth which says Bitcoin has become very, very expensive. So I'll buy smaller coins. Maybe one day my coin will also go to $50,000. That's absolute wrong. Gains are always in percentage. Even if Bitcoin is expensive, there are 100 million satoshis in every Bitcoin. You don't need to buy one Bitcoin. This is a good way to fall prey to riskier side of the market. A lot of people say it's speculation. That's absolutely true. There is a lot of speculation in the market. Crypto investments are generally highly risky investments because there is so much volatility in the market. You can wipe out your entire account in a span of days. Okay, so it's very, very risky to trade in crypto. And also, there is a deflationary mechanism built in most cryptocurrencies. That's why it looks like the price just keeps going up. Also, there is one narrative out there. A lot of people say, hey, blockchain is great, but I don't care about cryptocurrencies, especially public blockchains like Bitcoin or Ethereum. Right? That's not true. Blockchains work only when there are incentives. I will invest in securing a blockchain through my mining machinery only when I get a reward in form of Bitcoin or a cryptocurrency. So without cryptocurrencies, there is throughout the world in last 7-8 years that blockchain has existed, there has been no successful blockchain implementation without cryptocurrencies, right? So if you want to read more tech about blockchain, I would really encourage you to do that. That's fundamental to how cryptocurrencies work. There is a myth, we talked about this, that Bitcoin cannot be traced. That's not true. Bitcoin is used for illegal transactions. That's also not true. Also, if someone is interested in looking at fundamentals of Bitcoin, from an investment perspective, I would urge you to go and read Bitcoin's white paper, which was released in 2009. That has a lot of fundamentals, math behind why the price goes this crazy. Right? I think that concludes what I had to say. I see that there are quite a few interesting questions. Let me just start taking one after the other. Okay. So Anvesh Shetty says, when one sells crypto in exchange for other crypto using P2P exchanges, how do we comply with AML provisions? Okay. So Anvesh, what we say is P2P, if you are doing any kind of a transaction, there is still money being passed. If the exchange is located in India, you are just depositing it in an Indian account. So you do not have to worry about FEMA or any kind of AML provisions. If you are depositing it in an exchange like, let's say, Coinbase, okay, that's they don't even have an entity in India that you can deposit to. Of course, that's a problem. There are sites like localbitcoins.com. Localbitcoins.com is essentially not. I don't think they have an entity in India. So the transactions that I do, I am transferring it directly to the party who is buying it. So let's say if I'm transferring my rupees via PayPal to someone sitting in Russia or US, of course I'm breaking that. But if you trade in an entity that's registered in India, an exchange that's registered in India, that should not be a problem. Umesha says, is there RBI restrictions on Bitcoin trading? No, Umesha, there was an RBI circular in 2018. The industry bodies challenged it in Supreme Court, and last year in 2020, Supreme Court ruled in the favor of industry, and they repealed the RBI circular. Since then, the banks have been hesitant to deal with crypto exchanges, but RBI doesn't restrict them from dealing with crypto exchanges. Anvesh again has a question. Says, in case of crypto obtained by act of mining activity, how do I ascertain the cost of acquisition to post? Okay, so mining only cost that you can deduct is your mining equipment. Please keep the bills and stuff like that. Your electricity, if you paid for it. Any, let's say, personal expense that you might have if you have a facility where you are working full time for months, years, you can count that cost. But essentially, look at mining activity as a business in itself and treat it that way, and you will know how to do it. Even if you have small mining rig at your home and you are just doing it as a hobby, think of it as a business, and you will know how to calculate that. How do we determine the jurisdiction in respect to DAOs? Wow. So let me get into this. DAO, decentralized autonomous organizations, called DAOs, are sort of organizations on blockchain, and they are run only by smart contracts. So smart contracts define how this DAO will function, and they function that way. Anvesh, I'm afraid that just putting money in a DAO, I think right now most DAOs are not in a jurisdiction. The philosophy behind a decentralized autonomous organization is not to be in a jurisdiction. So unless it is specified, I would usually treat it as giving money to a software who is doing trading on my behalf and giving me money. It also depends on why you are giving this money, right? A lot of DAOs are essentially trading bots. If I use that, it's just software where I'm giving them, there is no jurisdiction, there's no contract I'm signing with them. But if there is a DAO that's registered, that has an entity registered in US, if you're giving them money, of course, that will be counted in that jurisdiction. I don't think there has been any country except Japan who has specific regulation relating to DAO. So this is a pretty big gray area. Usually what we say is be very safe, be extra safe when it comes to anything that's a gray area. Ideally, I wouldn't do that. Chandrakant Rao is saying whether cryptocurrency is linked to intrinsic value of any asset or sovereign guarantee, who measures, monitors, and declares the intrinsic value. Okay, so cryptocurrencies essentially are based on a philosophy that you do not want a sovereign to guarantee its value. What we've all been taught in our economics class is Keynesian economics, right? We studied John Maynard Keynes. There is a competing school of economic thought called Austrian economics. Keynes, what he says is there needs to be sufficient government interference in form of mostly monetary policy to control these prices, interest rates, bank rates, stuff like that, supply of money. Austrian economic thought says free markets are the best. Government should not intervene at all. And that's the philosophy on which Bitcoin and most cryptocurrencies are based. So the value is purely market driven, absolutely purely market driven. That's not to say that you cannot predict it. In fact, something like Bitcoin is super predictable in its price, because there is a math built in its code of how Bitcoin operates, right? So there is a method to the madness, but essentially it's just free market, right? No one controls this. Anvesh again says when one buys crypto in exchange of another crypto using P2P exchanges, how do we know whether it is interstate supply or import? If you're doing it, import is easy to recognize mostly because you are trading with an individual or you are trading with an exchange, right? And there's a fiat transfer involved in this. Let's say if you're doing, okay, yeah, you're asking crypto to crypto transactions. Crypto to crypto transactions, you cannot know. Safer side, deal only with Indian exchanges. Certain exchanges do have an Indian entity, and you can usually go and check that out on their terms and conditions or privacy policy page. But let's say specifically, if I were to deal with an exchange that just doesn't operate anywhere else except maybe let's say UK or US, I wouldn't do that. I just wouldn't do that. Also, P2P exchanges, what is the wallet that you're transferring your crypto to? Is that wallet, does that wallet belong to the exchange? In that case, if the exchange has an Indian entity, okay. If not, don't do that. If let's say crypto to crypto transaction, I'm transferring it directly to the other party, then there is a problem. But P2P exchanges work in various ways. All of them are differently designed. All of them have different legal structure, ways to do that. So be very careful. Easy way, deal with Indian exchanges. Parinit Rao says, from a general perspective, how does one distinguish one cryptocurrency from other? Is there a SOP for creating mining? Parinit, we are sort of in 1995 of internet era. We are just sending emails right now, and it's very slow. These things will be created in future. The frameworks that I'm giving you, the buckets that I'm giving you, are something that I've just developed from experience. Right now, we are very early in the industry to have these frameworks in place, but they will be developed over a period of time. People will understand how to compare, how to compete, how to sort of benchmark with them. Today, the industry is evolving at a rapid pace. So probably a couple of years time. Anvesh says if one purchases crypto when he was outside India and sell it when he is in India, yes, of course. Place of transaction matters a lot. Uh, Ideally, avoid all of these things. Don't go abroad and purchase. Don't tell your cousin in the US to purchase and send it to you just because there's a 5% discount out there. Both will get in trouble. But essentially, if you are not on Indian soil, I think there is also consideration of the place where the transaction was conducted. So it's just easier to be here and do it. Chandrakant says Bitcoin white paper published by Satoshi Nakamoto, who is the anonymous inventor of Bitcoin. We don't know who this guy, girl, or group of people are. Why ransom is demanded in Bitcoin if transaction can be traced? So this is a really good question. Primarily, the perception that Bitcoin cannot be traced is built because ransom is always asked in Bitcoin. So Bitcoin has there are ways to keep it completely anonymous, but it's just a matter of time till governments develop algorithms to trace these transactions. Okay, Today you can encrypt them, you can do, you can send them to mixers and stuff, and you can sort of hide your Bitcoin if you are absolutely thorough with the technology part of it. But one day there will be software. This is all a race of processing power. Who has more processing power, right? So the day Indian government develops a software that is capable of cracking the code of this transaction, they will knock at your door. So these hackers are not very well equipped as well. Okay, the biggest I think was the Silk Road marketplace that dealt in Bitcoin mostly in 2014. I think the founder has been caught. Most crypto transactions that happen by scammers, frauds are caught. This is not known to everyone. Parineet is asking again, is there any instance of traditional players in the industry have, oh, I am not here to market the industry itself, but now that you've asked, I think most large funds are already in it. Fidelity, BlackRock, JP Morgan, uh, top 20 funds in the on the Wall Street are already in crypto. They have publicly declared Bitcoin holdings. Companies like Tesla now are buying. I think everyone knows that. In India, there are already corporates who have invested in crypto. A lot of Indians have holdings in places like Singapore for regulatory certainty, but most of them are already invested. They don't want to go public with something like this. But yeah, so that's the traditional players are in it already. They are in it, especially large funds. Uh, Santosh asks, as of now, people are more tend to buy Dogecoin after Elon Musk's push. Is it better to go with the trend? So I get too many calls and messages from friends and family who say, I wanted to buy Dogecoin. I did buy Dogecoin. You told me not to buy Dogecoin, stuff like that. So I tell them, you can, of course, make money gambling. No doubt about that. You can go to a casino and you can get $1 million. But that's not a certainty. There is a lot of risk associated with that. So we don't know where it is going to go. Okay, these everyone knows Dogecoin is a meme. It's a joke. Of course, you can trade in a joke and you can make money. But do you want to do that? Is that your trading strategy? For most investors, I think no is the answer. Yeah, if you want to put in 5,000 rupees and get some adrenaline rush out of it, no problem. But when these coins crash, like smaller coins in crypto market, when they crash in the bear market, they lose 97% of their value. So imagine if I invest 1 lakh rupees today, after a year, I wake up, I look at my portfolio and it's 3,000 rupees. That is going to drive me crazy. So instead, just stick with large caps, like people do in stock market. Unless you understand fundamentals, it's crazy. Dogecoin, I think there is one wallet that holds more than 60% of Dogecoin. That means there's one person in the world holding so much of supply. That's madness. The day this person dumps it, price is going to go through the floor, and you can't be sure when they do it, right? So this is a problem. Uh, Santosh is asking, which cryptocurrency do you think? I can't recommend any cryptocurrency. Okay, I don't even think you should get into cryptocurrency investment until you learn about it. Go to a few nice channels, understand the fundamentals, read Bitcoin white paper, understand how cryptocurrencies operate, what is a consensus mechanism, a lot of technicalities in it, and then start investing in it. Otherwise, it's very easy to lose money. And then people who lose money at the end go on TV and say, hey, it's a speculation, it's a bubble. So don't get into that. Recommend me the next big coin. Even if you make money, it's not going to be worth it. Anvesh again asking, on a lighter note, can one claim loss under income tax if one forgets his private key? So I know what you are saying here, but I don't think you should do that. When regulation is in place, yes, of course, we hope that this is the same way to treat it. But I'm assuming that there would be some checks. Today, if I lose my gold, I have to go to the police. I have to file a complaint, to do a lot of stuff, right? So those things need to be in place before this treatment comes. Till then, even if you lose your private key, pay your tax for sure. That's the price we pay for being an unregulated industry. But that's also the upside, right? We get 100%, 200% returns in a year. So why not pay that back to the country that we belong to? Amita is asking, can you name Indian crypto exchange? I think what you should do is you should go to coinmarketcap.com. That's like our cryptocurrencies money control, right? Usually you go money control and research for a stock, right? Go to CoinMarketCap and you will see a lot of exchanges. You will see everyone's fundamentals, figures, and stuff like that, right? You can find that out. All crypto information, whether you are researching a token or an exchange or anything, go to coinmarketcap.com. They are the most reliable with it, right? Awesome. I think if there are a few more questions, I can take them, or we are done, almost on time.
Gautam, hello, sir. We are very grateful. Hello, sir.
Yes.
We are very grateful to you. It is a new subject to us, at least to me. So now Gautam will take over. Gautam, you please take over.
Okay, sir. Prasanna.
Yeah, I think all the questions have been already answered. So yeah, all the thank you messages are coming up in the chat box. So I wish to propose a formal vote of thanks on behalf of the branch. So first of all, I'd like to thank the first speaker. I think Gautam has already thanked him before leaving the program. Still, formally, I wish to thank CPE Sridhar sir for joining us today and enlightening the knowledge of members on the FEMA regulations in respect of foreign direct investment. The next comes the important and most awaiting session on cryptocurrency, because you are just hearing about the cryptocurrencies in the market, and a lot of them are dealing with the cryptocurrencies, but we are not understanding the fundamentals or the backbone of the cryptocurrency. So we had a very resourceful person today, the Farin Lathia sir from Bangalore. So on behalf of the branch, I would like to thank Farin Lathia for joining us today and enlightening us on the basics of cryptocurrency, the future, and how the cryptocurrency actually works. So we'll take your suggestions as to not to invest in cryptocurrency unless we understand it. So thank you for all the important suggestions you gave during this session. And I would like to thank the technical team of A1 Logics for giving us a platform and helping us out in this technical session. Further, last but not the least, the members, students, and all the participants who have been very supportive and encouraging the managing committee in conducting such sessions in the near future. So thank you everyone for joining us today. Thank you.
Sir, Praveen sir.
Yeah.
Parin sir.
Yeah, I'm not on mute now. Thank you.
Yeah.
Thank you for organizing this. It was an amazing session, and you have a wonderful audience. I hope it was of some value to everyone. And thank you for your team for organizing this. This is amazing.
Thank you.
The
Thank you.
smile which is in our
thank you.
chairman's face, I think there are many bitcoins held by him.
No, till now I don't have, but after hearing, I may think.
So he
it is,
first got himself. So he first got himself clarified why the ransoms are asked,
No,
so that even if he ventures into it, he can safeguard himself.
had I purchased some 15 years before some Bitcoin, I would be now a millionaire, or I don't know.
Had he
How much
purchased
it would have
15 years
been.
before some gold coins itself, he would have become millionaire.
It's not about the 15 years before. It's about next 15 years. What